Morning, everyone. I wanted to start the recording at exactly 9 a.m. Eastern time for timestamping purposes of this video. I wasn't sure if we were going to record it. I think it's better to record it because some of the questions you guys pre-submitted have been absolutely excellent. And I don't want my answers to just kind of go to waste. So we will record it. We'll provide you guys with the video. And then at the end, I do, get everybody's permission. And if everyone is okay to put this video up for sale for maybe a little bit more, then obviously those that have made it live and got their questions asked will do it, but we don't have to, okay? So it's something to consider. I just don't like wasting really, really good content. So I am going to record it, and we can provide the video to you guys. Also, at the moment, everyone is just muted and is in the background. If we have time at the end, I wouldn't mind making this more interactive. We can turn on the microphone and we can let you guys speak. I can also give you guys camera privileges if you like, but we will have a fair number of people here. We're kind of gonna play it by ear. I've organized the questions, and they're pretty good. Actually, let me. I want to save this one more time, and I have people helping me with timestamping. This way, the timestamping will actually work. Give me 1 second, guys, and we'll begin in a minute. Maybe I'll keep the timestamping myself as well. I'm just going to start a timer. Well, or a stopwatch. There we go. All right. Hey, thank you all for participating. We are going to go ahead and start with the Q&A session. I'm going to try and get everything done in 3 hours. Not going to... I don't want to waste too much time. Most of it will be over screen share. Still trying to find the best way to organize everything across my screens so I see all your questions that you've answered. And there's also a Q&A button in this webinar. There's a couple of features that you want to know. There is a Q&A button where probably better to ask questions in there. Use the Q&A button. And also there's a raise your hand button. So at the end, when we do turn on your mics, you can just raise your hand and let us know, and I will provide speaking privileges. Let me, sorry. Well, we are already recording, so this will be in the video. Lesson for next time is to make sure everyone is in here like 15 minutes earlier so that the actual Q&A begins right on time. And I want to make sure I don't miss anything. Okay, try to timestamp it myself. All right, oh, I should have already started the timer. Damn, okay, I'll just go by minutes. All right. Okay, so we'll begin the first question in 1 minute, so we'll start at 1:05. It'll just be so much easier for you guys to reference the exact question within a 3-hour video. Hope everyone's doing good. We start in 1 minute. And we'll have 2 little breaks at the top of each hour. Okay, guys? Don't forget the Q&A button and the raise your hand button. And there is a general chat. And here we go. All right, question number 1, and it will require screen share. I didn't list the names of who asked them, and the questions are not in order that you've asked them. I've reordered them for better use. Okay, so first question. What is the most bullish, most bearish, and a moderate outlook on the price of Bitcoin on a 3 and 5 year time scale approximately? Okay, so let's go to screen share. And we're going to take a look at the monthly chart of a Bitcoin. So here's the monthly chart on Bitcoin that I usually pull up during the general YouTube videos. I think at the moment we are higher than I anticipated. So by being higher than I anticipated, that leads to 2 outcomes. One of the outcomes is that we are actually a lot more bullish than I had originally thought. The other outcome is that the bear market is going to last even longer, because instead of bottoming out around this time and then having a smooth path to the upside, it could lead to a bottoming out later. And for one, that becomes dangerous, because if the bottom in price starts to come in after the halving, that becomes dangerous. Now, I will say that by going up the way we did earlier than I anticipated, it does increase the probability that we are going to go to new all-time highs earlier. That probability is higher. Now, we've lowered the probability of an extended bear market by going up so much early. There are still a couple of things that worry me, and the biggest thing that worries me is the lack of new buyers of Bitcoin, the lack of mass adoption, the lack of noobs coming into the space. There just aren't any, okay? That concerns me very much. What I think is happening is this exodus out of altcoins has mostly been driving the price higher. And when the exodus out of altcoins stops, and there's no noobs, there's no fresh blood coming in to buy Bitcoin, that could cause a big gap. And that's what causes flash crashes. Flash crashes aren't caused by a fat finger short seller. Flash crashes, or a seller in general, flash crashes happen when there's just no new buyers and there's always sellers. Someone always has to sell. No one has to buy. And when you happen to reach an environment, and it's usually completely random and unpredictable, when you reach an environment where there just happens to be no buyers, but there's always sellers. Everyone's always selling for one reason or another. You got to pay medical bills. You want to buy a house. You're getting scared of any speculative asset. And that causes a big crash. So to answer the specific question, my most bearish case is we dip just under $3,000. I no longer see 1,500. Like, the probability of that is insanely low. We're talking like 1%. My most bearish case is a dip to 2,800 sometime in the next 9 months. Like, maybe the worst case scenario is immediately after the halving, and people will get really, really scared. And then we can go up from there. Ideally, that would actually scare me if we dip to 2,800 after the halving. So the 2,800 dip would need to happen significantly earlier. It would have to happen sometime this year, and time on that is running out. And therefore, I am more bullish than bearish here, but I'm still looking for a correction. So my most bearish scenario is a dip to 2,800, but not much lower than that, okay? And it has to happen this year. That's my absolute most bearish scenario. My moderate outlook is a dip to the 5,000-ish area. That's the moderate outlook. Also this year, and then go up from there. And my most bullish outlook is only, I'm still anticipating a dip, but it doesn't have to happen. But my absolute most bullish outlook is we stuck in this consolidation phase of $10,000 going into the halving. And that's not most bullish. I mean, we can break out the new all-time highs tomorrow. But my bullish case, my reasonable bullish case is that we stay above $8,000 and then take off the new all-time highs after the halving. Okay. Yep. And 5 and 3 year outlook. So I believe that in 3 years from now, we're going to be sitting in the same position talking about the next halving. I would anticipate the price of Bitcoin. Well, if we look at this chart, right, and we're more bullish than this chart. I anticipated, so January 2023 is approximately 3 and a little bit over 3 years from now. And you see that I have the price at $50,000. I think that's reasonable. I think that a 3 year outlook for a $50,000 Bitcoin is pretty reasonable. That's my personal opinion. If we go out 5 years, there'll probably be another significant dip. So my 3 year outlook and my 5 year outlook are actually about the same. It's about $50,000 per Bitcoin. But in between that, I do anticipate us to go higher. But I also know that Bitcoin goes up too much and then it falls. So I can definitely see a move to the $75,000 area, but then fall under 50. But where do I expect Bitcoin 3 years from now? Around 50K. Where do I expect Bitcoin 5 years from now? Also around 50K, but in a much more safer 50K in 5 years than a 50K in 3 years, if that makes sense. So somewhere in between those two 50s, we're going to go way higher, and we're also going to go lower, probably back to 20K-ish area. Okay, hope that answers it. Thoughts on where we might be in the hyperwave on Bitcoin? I haven't gotten that question in a while, so let me open up the chart for hyperwave. Oh, I want to do a timestamp. So this is, so I'll just do it myself at 12 minutes. So the question is, thoughts on where we might be in the hyperwave on Bitcoin, because this hasn't been discussed in a while, and that is true. Let me see if I can get my hyperwave chart open. Bitcoin hyperwave. So we're still in phase 7. Like, I don't really need to look at the chart to tell you that we are in phase 7 of a hyperwave. Okay. So Tyler and I it's crazy that I disagreed with Tyler on something hyperwave, but it felt to me like phase 6 was a little bit longer than he thought it was. And to me, this is kind of phase 7, though now that I look at it, Tyler was probably right. So look, phase 7 of a hyperwave says the following. Either we're going back to phase 1 or we go to new all-time highs. So the Bitcoin hyperwave stays in phase 7 until one of those two conditions are met. So there's only two conditions that end phase 7 of a hyperwave. And that is new all-time highs, which we have not had yet, or a move back to phase 1. And phase 1 is at approximately $1,000 or $1,300, that area, okay? So we're still in phase 7. We had fallen below phase 3, and I believe oh no, I'm sorry, that was phase 2. They're a little bit different. Oh, I redrew this. Okay, so that was phase 3, and that's phase 4. So we had fallen below phase 2. And, but we never made it to phase 1. And I really think that the reason why it didn't happen and the reason why hyperwave probably completed is because hyperwave was created without an environment of an asset that has halvings. And I think this halving chart that I pull up every now and then, because remember, Hyperwave says that you need to fall back down to the prior area of horizontal resistance that lasted for years. And that area was $1,000 or $1,300. But because of the halving, minor profitability did come back to its starting point. So it's very possible that the hyperwave in Bitcoin has ended because it had reached its ultimate bottom. And maybe that bottom wasn't 1,000. Maybe that bottom was 3,000 because the halvings had something to do with it. In which case, the hyperwave on Bitcoin is over. And just because the hyperwave is over doesn't mean it's going to new all-time highs. It just means that that's a potential buying point. And obviously, Tyler and myself both underestimated the buying opportunity at $3,000. That's fairly clear at this point. I still think we can pull back and you can still get a good buying opportunity, but perhaps not all the way down at 3,000. At least I wouldn't wait that long for a big rebuy. I'd go in a lot earlier. So other than that, you have to wait for new all-time highs. So that's pretty much it. And if we are still in phase 7, the price of Bitcoin can go up to $18,000, and we're still going to be in phase 7. It doesn't matter how high it goes. It either has to break new all-time highs or it has to get back to phase 1. So we're either in phase 7 or phase 7 has completed. But even if phase 7 completes, Hyperwave doesn't tell you to buy back in back at phase 1. It just tells you that Hyperwave is no longer relevant to this asset. And you use other metrics to buy back in, whether it's fundamental or moving averages or whatever you like. Okay. In hindsight, you know, the Ikenashi with TD sequential certainly called the ultimate low in the current bear market, but I wasn't looking at Ikenashi sequential. I do now. Okay. Next question. Hypothetically, if a person's net worth is in millions and he fully believes in Bitcoin, what is the maximum exposure he should have to Bitcoin percentage-wise for the net worth? It's impossible for you to answer, guys. I'm not really a financial advisor. I would say if your net worth is in millions, I would be very comfortable holding up to at least 10% in Bitcoin. I would hold it in cold storage, at least 10%. So if you are, so we're talking net worth and we're talking disposable income. So those are two very different things, okay? You can have $1 million paid off house, but no job and almost no money, right? So it's possible that you inherited your parents' house and the value of that house is $1 million. So let's talk about net worth, excluding your primary residence and completely illiquid investments, right? So $1 million house doesn't count. If you have a business that a profitable business you can sell, if you have assets that you can sell, if you have stocks, if you have $1 million retirement portfolio, right? If you have $1 million in a retirement fund that you can't touch for the next 20 years, and you do have some income, I have no problem holding at least 10% of that amount in Bitcoin. So if you have, let's say, $1 million in your retirement fund and you have 200,000 in the bank, I personally would be comfortable holding up to 100,000 in Bitcoin because I know I have $1 million in my retirement fund as long as I don't lose that $1 million in my retirement fund, right? As long as I trust the government of the country doing that retirement fund and so on. So to me, if you're skeptical about Bitcoin, but you want exposure to it, 10% is plenty. If you understand the inner workings of Bitcoin, like I am a huge believer in Bitcoin's fundamentals and the technology of Bitcoin, I'm comfortable holding 20 to 25% because to me, it's safer. It's the safest place I can hold my money because it's unconfiscatable. And I believe in the future of technology, and I believe that Bitcoin will succeed. But my responsible answer is 10%. Okay, next question. Yeah, and feel free to add more questions as we go, and I'll try to, allocate my time properly and get to it. Your personal opinion on when will we break the all-time high on Bitcoin, earliest and latest? Can we plot a chart or a trend line predicting 8 to 10 year outlook? It's very similar to a question I answered. I should have probably, I must have missed it when I was organizing the questions to add it to the other one. When will we break all-time high? Well, since I anticipated us to go a little bit lower in the 2019 bear market, I did not anticipate the break of all-time high until 2022. I believe this should be sooner now, okay? I don't believe, but however, I think the road to new all-time high is going to be a little bit more challenging than people expect. I may eat it here, but I do think that we will probably break all-time high in the second half of 2021. I don't think it's going to be as quick as people think, okay? It's possible we can do it tomorrow, of course, but I don't think we're going to break it until a good year after the halving. I think it'll take another year after the halving in May of 2020. So I'm looking at the second half of 2021 to potentially break the all-time high. 10-year outlook, I mean, if Bitcoin is not over $100,000 in 10 years, it's possible that it will be failing. It has to. Adoption of a technology like Bitcoin 20 years after invention has to come. So 10 years from now, by the year 2030, I would need Bitcoin to be over $100,000 US, if not significantly higher. Otherwise, it may not function very well. Okay. Next question. Percent chance of falling to prices like 3,000, 5,000, 6,000, 7.5 to 8,000 if we fall from here, and what percentage to allocate for each of the above levels. Again, not exactly advice, but I'll just give you my best thinking on those. Okay. I think the percent chance that we fall to the $7.5 to $8,000 range is pretty high. It's pretty high. I think there is a greater than 50% chance that we fall to the $7,500 range. Okay, I'd say a good 60% chance we're gonna fall down below $8,000. That's what I'm looking at. If I wanted to buy Bitcoin in those areas, how would I split it up? Okay, well, let's go through the percentages first. I think there is about a 60% chance plus that we will fall below 8,000. Now, what about falling down to 6,000? I think falling down to 6,000 has actually a slightly lower than a 50% chance. So maybe a 45% chance that we're gonna fall all the way down to 6,000. I think going down to 6,000 is now slightly less likely. Bitcoin is holding up really well here at the top, and it helps it. The longer Bitcoin stays stable and altcoins die, the more likely people will eventually discover Bitcoin and its usefulness. So now we're dropping the chances of 6,000 down to 45, but if we do fall to 6,000, 5,000 becomes very, very likely. So the chances of going down to 5,000 is not that different than going down to 6,000. So if I'm given a 45% chance to Bitcoin falling as low as 6,000, I will, oh no, I forgot the microphone, guys. I'm sorry. The audio on this must have been terrible. I knew there was something I forgot to check. I have no idea what microphone was being used, but it must have been horrendous. It should be much, much, much better now. Sorry about that. that means that the chances of going down to 5,000 is only about 40%. If we go, if 6,000 is 45, going down to 5 is 40. They're almost the same. However, going all the way down to 3,000 is lower. So I would give that maybe a 20 or a 15% chance that we fall to that $2,800 range. It's still a chance. It's still a larger chance than most people. But the chances going all the way down to 3 or lower are significantly different, but the chances of going down to 5 or 6 are almost the same. Okay, so so if I had a stash of Bitcoin, if I had a stash of cash that I was looking to allocate into Bitcoin, how would I do it? Well, I would basically do it by those percentages, right? So I would look to put in about 50% of what I'm looking to buy into. Let's say my goal is to accumulate 10 Bitcoin in at the best possible prices. So I would try to probably buy half of that on a dip we're talking about, right? So on a dip, I would probably try to buy about half that in that $75,000 to $8,000 range. And then I would buy the other majority of that in the $5,000 to $6,000 range. So maybe 5 Bitcoin around 7.5 to 8 out of 10, and maybe 3 to 4 more Bitcoin in that 5 to 6. And then either I would find additional capital to put in at 3, or I would just buy that last couple and just consider myself lucky. Again, I like to buy on the way up, not on the way down. I prefer to be confident in a breakout and buy the breakout. If it falls far enough down, it's also, you know, if you don't have any and it falls a lot, then then that's another place to buy. You know, if you didn't have any Bitcoin, picking up a bunch in that $3,000 range would not have been a bad move. Okay. Next question. Where are we here? We're 27 minutes in, but we started a little bit late. Okay. A long-term outlook on gold and the possibility the next bull market top of gold, your personal view, and what are the chances of a gold standard? You know what, we'll do that as a question A. So let's just pull up the chart of gold, a longer term chart, and take a look. Maybe I'll pull in the monthly chart and we'll take a look at it. Okay. All right, so here's the monthly chart of gold. And I do think that a new all-time high is possible. But I have some concerns. I don't think the stock market is ready to have a significant pullback. I think the economic activity is still okay. But a realistic chance of a gold new all-time high, I believe is reasonable. And I think we will have a new gold all-time high because it is breakout, because we broke the 38%, everything changed. I was a big bear on gold as long as we stayed below the 38% line. But we've broken this 38% line, and gold has gone up across all fiat currencies. That's also very, very important. So my probability of a new all-time high has significantly gone up. And while if you asked me last year, when do I think gold would make a new all-time high, I would have said, you know, on the back end of 2020s. Now I think it's higher. I think gold is going to be very, very similar to Bitcoin. I do think gold has a good chance of making a new all-time high before the year 2021, where before I thought it was going to be closer to 2026. Okay, so there is a possibility of gold going higher. How high do I think gold can go? I can't see gold going above 5,000 US dollars. I can see, you know, another mania into gold, but I don't see it going above $5,000. I would be a seller of gold in the $4,000 to $5,000 area. Like the gold coins that I have, they're going to get sold in assuming Bitcoin is thriving. Like if Bitcoin dies, then it's a different story. But if Bitcoin is thriving, I would be happy to get out of my gold in that $5,000 to $10,000 price range. Now, keep in mind, we're talking about this in a non-hyperinflationary environment. So when I say gold to 5,000, it means that the purchasing power of the US dollar is not that different than the purchasing power today. I mean, maybe it'll be 10% lower. Like, the rise in gold has to significantly outpace the inflation value of the dollar. And don't listen to the crazy inflationists, right? Like, yes, prices have gone up, but if you're but in the last 10 years, your dollar doesn't buy you that much less. Like, your dollar won't buy you that much less than in the last 10 years. And also keep in mind, your salary is a lot higher than it was 10 years ago, right? Especially if you're progressing in your career. So we are talking about a reasonable, non-hyperinflationary environment. And if gold goes up to 4,000 to 5,000, I think that's a pretty good area to consider getting out of gold. And I think that's a reasonable target. All right, so let's do a follow-up question. What are the chances of a gold standard again? And if it happens, will it adversely affect or kill Bitcoin? I don't see a gold standard. I really, really don't. I don't see it at all. If anything, I see countries creating a basket of things, and gold is a part of that basket. But because I don't think the governments will ever admit that they want to go to a gold standard, so they're gonna pretend. And what I think is more likely to happen is they will create a basket of things, and gold will be one of the things in the basket, but not just gold. They'll also put silver, they might put copper, they might put palladium, they may not put platinum, they might put, industrial metals, right? And they kind of mask it. And then they might put, real estate, or they might put value of national parks, or they might put oil, or if oil is going away due to renewable energy, they might put like renewable energy, like based on how much renewable energy a country creates, right? The environmentalists, there's this whole push for environmentalism, and they might say, hey, based on your country's health, based on the well-being of the people in your country, how green the country is, that goes into the factor. Basically anything to create confidence. The only thing that a currency needs is confidence. It doesn't need gold. Gold would create a lot of confidence. The more gold your country has, the more confident people are in the government acting responsibly for the well-being of their citizens. But countries don't want that, because they don't want to. They want to be able to fudge their currency. If you go to a full gold standard, that means the leader of that country cannot screw with the money. But they all want to screw with the money, so it's this balancing act of the ability to screw with the money while giving people confidence that the money is valuable. And I think that in the future, if currency has to be redone, they're going to cling to the cryptocurrency meme. We're better than Bitcoin because Bitcoin, no one is in charge and it can fail, so we're better. And there is some mathematical rules. We can tie it to GDP, so we can't print money forever, but we're of control of the GDP metric on the back end, so we can fudge that a little bit. So they're going to find their back doors to fudge with the currency, and they may be forced to stick some Bitcoin, they may be forced to stick some gold into that basket, but it's going to be such a small part of that basket just to give people confidence that gold is involved, but it will not have a direct effect on the currency. It's more as a, yes, we have gold. It's kind of like, I don't want to equate it to this whole, proof of stake scams, but it's kind of like Dan Larimer's project with Steemit and BitShares, where 2% of the blockchain is proof of work, and 98% of the blockchain is proof of stake. But then he gets to claim that we're a hybrid. You know, we're a hybrid. We're a proof of stake, proof of work hybrid. Like he's not going to clarify that it's only 2% proof of work, which is totally meaningless. So the same thing will apply here with gold. Like there'll be gold in possibly there could be, they'll say, we're on a gold standard. Gold is part of the basket, but it's like 1%, right? So it's effectively meaningless. That's what I see. I don't see a straight up gold standard. Okay, hope that answers that. Okay, next question. Hey, you know what's best, guys? If my answer is unclear, raise your hand. I am gonna keep an eye on who's watching us live, and there is a raise your hand feature. So if a question is unclear, raise your hand, and then I will look through the chat and any follow-up questions. Okay. All right, let's move on to the next question. I had like 25 preset questions. We're on number 6, and then I'll take away live. I do want to get through at least 10 of them before the break, so I have 4 more to go, and then I'll organize your next set of questions during the break. Okay, here we go. Next question, just getting the timestamps. Okay. Oh, okay, so now let's talk about TD sequential. Let's talk about trading for a little bit. I heard you mention that you don't weigh TD risk and TD support resistance lines too heavily. I've had good success using them, but wanted to hear why you don't care for them so much. That's a very good question. Okay. Let me just grab any asset. Let's go to a stock. Okay. So I do weigh setup trend pretty heavily, right? So right here, this red dotted line on Dollar Tree is important to me because look, right here, you got rejected by the setup trend line and the stock went down big, and this is just one day. Right here, we broke and closed above the setup trend line and we accelerated to the upside. I do care a lot about the setup trend line. That's important to me. Do I factor it into my analysis? I would if I was actively trading the asset. But look at it over here as well. See the break of the setup trend line? And we accelerated down this green line. That I do care about this quite a bit. Okay, so absolutely, and I've mentioned the setup trend line many, many times. Now, what about the risk line? The risk line, not so much, and here's why. Because the risk line is really meant as a stop loss for when you are entering trades off of a 9. And to me, it's usually just too far away. I prefer my stop losses to be tighter and closer. To me, using the risk line usually provides too much risk. Not always, but it usually does. Because the way the risk line is calculated is it takes the distance, it takes the lowest point right here. It takes the lowest point of a candle and it just extends it down. So the risk line gets created by taking the range of this candle that made the ultimate low in a move down to a 9, and it just doubles it. And to me, that is just too much risk. I like to have my risk set just lower than the swing low of a move. But this doesn't just, this puts the entire range of the candle. And what usually happens is the candle that creates that high or low is usually has a big range, and it's just too much for me. Like here's another example. Here's a beautiful 9 candle on what is a borderline reversal candle. When would I enter the short trade off of this 9? I would consider entering on the 9 candle itself, but the perfect time to enter it is when this next candle starts trading below the low of that candle. And the moment I enter this trade as a short trade right here at this red line, I know that if the stock then moves above the swing high of this candle, I've probably made a mistake in shorting that stock. Now, if it happens within hours after my entry, I may give it a little bit of a leeway. But if it happens the day after, there's no way in hell I'm staying with the short. I am taking the stop loss right here. The risk line tells me to be patient all the way to there. And I don't want to do that. Like, I don't want to risk more money. So to me, the reason why I don't use the risk line is that it is, it's too far. Like, here's a perfect example. Here's a 9, right? And this 9 is actually a bearish candle. You can see how it's a red candle. So it's actually a bearish candle. And this 9 is showing me weakness. And I'm like, oh my God, this stock is going to crash. Let's say I don't know what the next candle is. Let me show you specifically. I'm going to go to replay. Oops, what did I do? Not sure what I did. Hold on. Why isn't replay working? Let me refresh the chart. Hold on. Reload. Oh yeah, let me show you a quick example and then I'll move on with the next question. Let's say I didn't know what, let's say I'm looking at this, right? And I'm gonna click next candle. Oops, click next candle. I have an 8. I'm like, all right, if this thing goes up, I'm gonna get a 9. If the 9 is showing me weakness or a reversal candle, I wanna short this asset. And here's the next candle. It opened up here at the top of the candle and it was trading down all day. Was trading down all day. I'm like, holy shit, I gotta take this short. Let's say I shorted in the middle of this candle, okay? I have to open next candle, basically, right? You see that right there? That's the risk line and the setup trend line. I don't want to put my stop loss up here. That is way too much for me. That's way too much risk for me. That is 4%. I don't want to risk that much. I don't want to risk 4% on this trade. I think that is way too much. I know the next day, I already know my short was probably a mistake. Where's my stop loss going to be? My stop loss is going to be just above that 9. Just above that 9. This is what that entries, exits, and stop losses webinar that talked about. I don't want to risk this much. I'd rather short, again, if I see a rejection in this area. Or I'd rather go long if we break this area. I don't want to sit on this losing trade all the way to there. 4% loss. Right now, I'm looking at only like a 1% loss. Look at that, 115. That is a reason because I know where I screwed up. I know where my mistake is. And look at the next candle. And I'm out. I took the stop loss. And now imagine if I had my stop loss at the risk line. Now what do? It still hasn't hit my risk line. I'm like going to bed feeling like crap, feeling like an idiot, right? And sure, and the chances are I'm panicking right here. Yeah, okay, fine, it didn't hit my risk line, but I'm still in the red. Now I'm praying I make money again, and I don't, and I still don't, and it was still a losing trade. I was supposed to exit here. My capital is tied up. I'm probably feeling good about myself that I'm lower than my stop loss. I'm feeling good about myself that I'm lower than my original stop loss that I didn't take. And now I'm still at a bigger loss. And now it's a bigger loss. And now it's an 8. And now I'm sitting on this short trade saying, well, I have another 9 coming. What's the point of exiting it's just mistakes on top of mistakes on top of mistakes. Would I go long on a break of the setup trend line? Of course I would not, because guess what the next candle is? The next candle is a 9. And there it is. I want to short this 9. But my rule number 1 is don't add to losing trades. And there's a chance if I did not exit my trade at this blue line, I am now down 6% in this trade on a stock. That's insane. And it's just mistakes on top of mistakes. I'd rather get out right here and short again off of this 9. So if the next candle starts trading lower than that candle, I want to be in that short trade, and my stop loss goes right there. Boom. Boom. I did not even know that was coming. My memory's not that good, guys. Boom. That's the trade. And guess what happens at the end of this day? I'm setting a break-even stop loss. And if it goes even lower, I'm going to put this straight down. There it is. I'm now putting my stop loss right here, and I have now made more money than I lost. The 1.15% that I lost, I have now gained. I am now up 1.5% in this stock. So between this bad trade and this good trade, I made money. And now I'm making more money, and I can start lowering that stop loss however I feel. And that is why I don't use the risk line for my stop loss, because occasionally it's just too risky for me, okay? But do I care about setup trend? Yes, I do care about setup trend. But in this case, setup trend was also pretty high. I love watching the break of setup trend like on a 2 or a 3. All right, long-winded answer, but I hope that covered it. Okay, part 2. Let's end replay. Yes. And let me drop these things so that they're not in my way for the future. Okay. So next question, our timestamp is 47 minutes in. Okay. When do you not care about the sequential 13s, and when are they important to you? Very good question, very difficult to answer. Since I happen to be looking at a random stock, let's find the last sequential 13. Here it is. They're important. This one actually would be important to me. So when are they important? To me, the sequential 13s are important when they occur in vicinity of the 9 and when they occur at a new swing high or a new swing low. So in this case, it's a new swing high, okay? So this 13 would be important. Also when they occur in a reversal candle. Also when they occur in isolation. And here's what I mean by isolation. Here is a red 9 of beautiful buying opportunity off the moving average. And look how we broke setup trend line on the first candle. That is big time. Very bullish, okay? You made a 9 on the upswing. And there's only one 13 count in the background right here, okay? But if I go to, even if I change this to a weekly chart, I think Dollar Tree has been very bullish. So here, you see how we have 1, 2, 3 9s in a row. I care about this 9 very much. But see this sequential 13? It's not exactly occurring in the vicinity of the last 9. And I know there is another sequential 13 in the background already that has had time to move. That's why this one is on a 5. And we just broke setup trend. So the next sequential 13, now there was another 9. So if this one led to a sequential 13 up here, I probably would not care about it at all. Because remember, Wall Street loves the sequential 13, but Wall Street would look at the indicator like this. So that 13 is not even there. This was a 9. There's no setup, and that was the only 13. So this second 13 from 2 consecutive 9s is a 13 I'm probably should be completely ignoring, okay? I care about the 9s consecutively, but Wall Street, they don't even see them. So you see how there is no countdown after this sequential 13, but in my default version, there is a countdown after the sequential. So this other count, I don't really care about, because on the actual time to mark sequential, it doesn't even exist, okay? So that's when I pay less attention to it. And also when there's multiple 13s within 13s, right? So when I get a couple of 9s in a row, they don't have to be consecutive, just in a row, okay? I care less about them. So that was a short answer to the sequential 13s. Okay, next question on TD. 15 minutes in. Oh, I have a hand up. Okay, Garth, you want me to give you speaking privileges and you want to ask your question, or you want to type it in somewhere? Okay, cool. Let me give you speaking privileges. All right, go for it. What's your follow-up question?
Oh, hey, man. So this is just going back to how you were talking about how you like tight stop losses. I guess that's just kind of how much, this is a very broad question again, how much is that in line with just your overall trading psychology or philosophy, where you said you like to hit a larger number, I guess I'm paraphrasing, larger number of doubles and not like swing for the home run all the time?
Oh no, that's why. I mean, because I use very, very tight stop losses. That's what it means. Like I want to use my capital wisely. I want my trades to work for me immediately, and if they don't, I go and look for better opportunities. So it's all about that. Yeah.
Cool.
Like I don't want to wait.
Yeah, I mean, you're a former Wall Street VP. Is that kind of more the Wall Street? This is a very broad question again.
No, that's actually irrelevant. Like the VP title is not crazy impressive. You just have you just have to be competent in your job and know what you're doing and be responsible. And my job, though it may have to do with my job, because my job was building risk models. So I was all about risk. So I was just watching hedge fund positions as we were analyzing the risk of those hedge fund positions. Yeah, and I've seen some dumb moves by hedge funds. That's more of just experience in being better with your risk, and then watching all those stories like the trader from Société Générale that lost $4 billion because he kept, couldn't admit his mistake to his bosses. So just get out of it early and go look for something else.
Yeah, I guess, is it true you kind of have a power law of hedge funds because of maybe people take these risks? And I guess I was asking more about the Wall Street, just that experience being to be a little bit more conservative as opposed to crypto land, shit coiners, everyone's aiming for a home run.
No, this mostly comes from that experience of working in risk.
Gotcha.
All right.
Hey, thanks a lot.
I'm gonna move on. And hold on. Yeah. Sorry, I muted you again. I wanna get through some of these, but yeah, you can put your hand down if you have another follow-up question. Well, I'll try to save some time at the end, and people can talk. Okay, let's move on to the next one. So let me just change the timestamp real quick. What are some other surprising, interesting things learned from building your alert notification service? I underestimated how many assets are always hitting 9s and 13s. I guess I knew that there were so many assets, but I greatly underestimated how many notifications you are going to get. And because of that, this becomes a very challenge. I always knew that programming the alerts is going to be challenging, but the sheer number of assets and the sheer number of alerts, like I do want to provide commentary on good 9 and 13 setups, but I'm starting to panic a little bit. Just how much of my time is going to be spent because you don't know. It's like, well, I only want to be notified of good 9s and 13s, ones that are most optimal for trading. But the only way to know if it's a good or a bad trade off a 9 is to look at all of the notifications, right? Like, so someone has to do that. And if we put, the S&P 500 plus all the main commodities and all the main currencies and all the main crypto, I mean, we are talking, like, I'd have to look at potentially 40, 50 charts per day in real time as alerts happen and provide some kind of commentary. And that seems to be a little overwhelming because everyone wants, their asset with commentary. So that's, I used to get these notifications and they were selected for me. Like I'd get like maybe 5 to 10 a day across the world. And I didn't realize that it must have been 50 to 500, probably closer to 500 a day that this trading desk would analyze. And then I would only get 10. But they must have been looking at 500 assets a day. And then they select which 10 to send us throughout the day. And that was a full-time job by like a team of people across the world. So that's the, I knew the programming part was going to be challenging. And also, programming this indicator properly is very, very difficult. There's too many moving parts and there's too many variables to keep in the back because there could be counts behind counts behind counts. And making sure that there's no bugs is very, very challenging. Okay, next question. I wanted to get through 10 before the break. I may not get through 10 questions. I'll come close though. Okay. How far apart can a 1 followed by a 2 be from a 9 and still be considered influenced by it? Okay. So you provide specific examples, which is good. Let me read the question one more time. How far apart can a 1 followed by a 2 be from a 9 and still be considered influenced by it? So here are specific examples. Say a red 9 is followed by a red 1 and 2, and then a green 1 and 2. Am I correct in thinking that the green 1 and 2 is a standalone entry at this point? That is correct. That is exactly my thinking as well. Now here's an example, right? Here's a good example. Here we have a 9 right at the high. The following candle is a 1, but look what happened on the next candle. The next candle early on in the candle was a green 2 going above a green 1, going above the 9, which normally tells me to be bullish the asset. Now, because this is a triple 9, I'm going to be a little bit less bullish than if it was the first 9 in the series. With this first 9 in the series that almost followed a red 9 at the bottom, but the 13 did mark the low. And this is a 13 I would pay attention to because it's the first 13. So here was a 9 at the high. Here is a 9 at the low. We can talk about this situation as well. This is actually another perfect example. But this 9 led to a 13 here, which marked the low. And it was in the vicinity of the 9. When a 13 occurs before the 9, it's even better for me. I don't like having this 13 after this 9. This 13, let's assume this was a 9 candle, not an 8. This 13 being right before it is actually very, very bullish for me. I like this combination. I prefer the 13 coming before the 9 than the 13 coming after the 9. I love it when they're on the same candle. But if I had to choose 13 right after or 13 right before, I want the 13 right before. So here is the first 9 in the series. So being the first 9 in the series, I'm very interested in going long the green 2, going above the green 1, also being above at least the body of the 9. But if the wick is not big, then the high of the 9 is also great. Now, when it happens on the second time around, I am more skeptical. Now I am bullish due to the fact that we've broken setup trend. And the unfortunate part for me is that the green 2 going above a green 1, going above the 9, already feels like I am chasing the asset. So while I would go long here, I would probably be very cautious in going long here. And if I'm cautious in going long here, I am certainly looking to sell and short off of the third 9 than I am even considering going long again. Now, it's possible this asset could keep going up and up and up and up without a pullback, and then I'm gonna say, fuck it, I don't wanna chase it. That's a chase to me. Anything up here is chasing. Anything up here is buying a breakout. And there are questions about breakouts coming up very, very soon, okay? Now, here, let's assume this ended as a green 2 right here. But then you had a red 1 and a red 2. It's completely independent, right? Because the green 2 going above a green 1 activates the bullish trade. I wouldn't do it because of the unreasonably big run-up. That brings me to this right here. This 9 makes me think go long. This 1 tells me probably have made a mistake in going long, this is the reason why I usually wait for a candle to trade above the 9. I don't care if it's a red 1 or a green 1, but I want it to show me strength after the 9. But this red 2 going below the red 1, going below the 9, breaking setup trend, entering the countdown phase, makes me enter the short trade. This green 1 followed by green 2 has to me no longer is relevant to this 9. It's completely independent. So your interpretation is correct. If I see this green 2 going above this green 1, because the short trade after the 9 has already been activated, I see this as completely independent from this 9. Now, if you look, you went a lot higher, you never broke setup trend, and in fact, you continued and ultimately reached the countdown phase with a new low, okay? And here is why I hate the risk line. Because if I would have went long in this area off this 9, the risk line, sure, I was up in money. Would I have taken profit up here? Maybe. But if I allow the risk line to be my stop loss, it took 3 months. Wait, it's a weekly scale. It took from October all the way to June before I got stopped out of this trade. And it never got me to a new all-time high, to a new swing high, or all-time high, whatever it was, right? So I personally would have been raising my stop loss, so I would have been out in this vicinity. But this green 2 going above this green 1 entry is not because of this 9, because this 9 told me to stay short. And you know what? They were both right. Staying short after this red 2 went below the red 1 break setup trend eventually made you money based on the rules of sequential, waiting for a 13. And going long on this green 2 above a green 1 also made you money, assuming you properly raised your stop loss. So both of the strategies would have made you money if you stayed patient and within the rules. But to me, this is a brand new trade. Has nothing to do with this 9. Hope that answered your question. These were great examples of that, by the way. Okay, so you have one more explanation. Let me read that one. Again, say you have a red 9 is followed by some chop, red 1, green 1, red 1, green 1. Would this also be a standalone entry? It depends. If you have chop after a 9, it's not a standalone entry to the short side, because to the short side, you're entering because of the 9 in a countdown phase lower, but it's a standalone entry to the upside,
Okay, so that's the best way I can explain it. So let me find a 9 with choppiness. Here's a 9 with choppiness. Okay, so right here you have a 9, not even perfected, and then you have red 1, green 1, no green 2 above a green 1, no green 3 above a green 2, red 1, though at one point this was a green 4 above a green 3, green, no green 2 above a green 1, no green 3, this is perfect chop. Red 1, no red 2 below red 1, this is complete chop. Now right here, you finally have a closed candle on a green 2 above a green 1. Is this a standalone bullish entry? The answer is no, because of the countdown phase. You could have been long earlier playing the countdown, and the countdown ends right here on this reversal candle, significantly higher than this 9. That was not a bad percentage gain. Remember, this is a weekly chart. After this 9, if you went long after the 9, thinking you're going to enter the countdown phase, let's use even the top of this candle. That is a 24% gain. That's nothing to sneeze at, okay? That's a serious gain. I mean, if I do this, very serious gain, right? But it's not a standalone entry to the upside because you're playing the countdown as well. But if you're going to enter the short trade, and there was never a reason to do so, because you never had a red 2 going below a red 1 at any point. But if there was one, let's say this red 2 started trading below this red 1, that is a standalone entry into a trade that has nothing to do with this 9 because it happened so much later on. I think that should answer the question in full. Okay. We've got an hour, guys. Let's take that 10-minute break. I'll reorder the questions. Let's come back in exactly 10 minutes. I'm actually going to pause the recording so we jump right back into it. But if I pause the recording, I'm going to have problems. I'm going to have to do some math on the time scale. Yeah, I'm going to pause the recording and I'll adjust accordingly with the minutes, okay, for timestamping. All right, guys. Let me do this. Stop screen share. I'll say hi to you guys. I think this is going well. Let me pausing the recording now. I have to remember to unpause. Okay, and we are back. Let's pick up where we left off. I took a look at some of the newer questions, and but I still have my list, and we're gonna go from that. Okay. All right, here we go. Next question. And I'm going to get my timestamps right. And, okay. Some interesting theory or facts you have regarding the pi cycles and how is it used? Time has these amazing patterns, like for example, how pi cycle coincides with a country having a banking shutdown. This is fascinating. So I am nowhere near the expert at this. What you really want to do, and it's unfortunate, Armstrong Economics. Right. So I used to read this blog every single morning, for years, every morning. I used to read Armstrong's blog, and he's still posting. I really should find the time to read his blog again. I kept saying I'm going to go and reread them. So this is where I learned how critical time is to trading. I've attended Armstrong's conferences. I've never paid for his service called Socrates that's supposed to predict the market for traders. I've had free access to it for a couple of years, and I was in group chats with people that were using it to trade, and I found it to not be very good. Like, that personal opinion, right? Like, I could not trade with it to make money. Some people can't trade with sequential to make money, but I did very, very well, right? So, but what I learned about economics and markets and the psychology of markets and the importance of time all came from this blog. Okay. The Orlando WEC. Oh, it's the same days as the Bali event, so I can't make it. I would like to attend another one of his one of these days. Hold on, where is his other ones? May 3 to 4 in Rome. I don't want to go to Rome in May. Yeah, so it's not looking good for me. Oh, this already happened. This was past May. I think I could have gone. I think I was in Europe at that time. I didn't pay attention. But anyway, so this is where I don't want to waste time. This is where I learned all about it. And so you really want to read his work. And there's so much there. It's impossible for me to like explain this. So let's go to the follow-up question. It was fascinating to me too, and this is where I learned it. So you really want to read his blog. You really don't want to hear it from me, right? You want to hear it from the source, and you can. You can also listen to his interviews and videos and stuff like that. Okay. Oh wait, I'm not screen sharing. Damn. There we go. Sorry about that. So it's ArmstrongEconomics.com. Okay. So that's where you want to read all about it. Okay. All right, let me make sure we're recording. Okay, next question. It's still staying with the same topic, but it's a little more detailed question. All right. Let me get the timestamp. Would you discuss more about the pie analysis? Oh, here we go. Like I said, the different people ask similar questions. What margin of error do you give these points in time? Or do you sit on pins and needles until something happens? Now, technically speaking, since we have computers now, you can you can pin down the critical days down to the second, right? Because you know the birth time of something. You know the exact birth time of something, and therefore you could, and therefore you can pinpoint it down to the second. However, I like to think of it, I like to give it leeway. One of the reasons why I don't like automated trading, one of the reasons why I don't like bot trading is because they don't have a mental, they don't have, like, I'm not saying your feelings have to come into play. You want to trade like a robot. You really do. You want to have rules and trade like a robot. But here's a but coming. But as a human, if an asset is worth $100, as a human, you need to put some intuition. Did we set a new high by a penny, or did we set a new high by $1? And on a $100 asset, that makes a difference. But for a bot, it doesn't. Or let's say $1,000 asset, right? So the reason why I don't like bot trading is because they don't have a mental sense of the difference between a penny and $100. And you do. So it's the same thing here, right? I want to intuitively know the difference between a day and a microsecond. So to me, if you're trading to the point of, well, we broke yesterday's high by a penny, and therefore I'm supposed to do this and this. And the answer is not necessarily. You know, maybe in this case, it shouldn't have been breaking by a penny. Maybe you should have waited 20 cents. And in other cases, maybe you shouldn't have waited for that penny. Maybe you should have got in 20 cents earlier, right? So there's a little bit of discretion that needs to be done while you're trading like a robot, but you're only 98% robot and 2% human. And that's why I don't like these things to the second, and I do give it some leeway. And obviously, the larger the price of an asset, the more leeway I want to give it. So on a $3 asset, a penny is very relevant. On Amazon stock, a penny is not that relevant. So same thing when it comes to time. If it's a cycle that comes around every 10 years, I might give it a few weeks leeway. But if it's something that comes around every week or every 3 weeks, I only want to give it an hour leeway, right? And if it's a cycle that's hourly based, I only want to give it a 5-second leeway, right? But there has to be a leeway as a general percentage of the time or price. And that's how I treat it. When calculating dates, it seems like there would be some rounding errors. And well, that's the thing. There don't have to be rounding errors. You can set a computer. You know when the Genesis block occurred. You know the exact second of the Genesis block of Bitcoin. You know the exact second when the email went out of Satoshi's white paper. These are 2 birth dates of Bitcoin. You know them to the second. Therefore, you can calculate future time cycles to the second. The leeway that I'm providing is that when the date to the second shows up, to give leeway around, like a mental human leeway around that date. Like, you know when the Declaration of Independence was signed. You may not know it to the second, but you certainly know it to the hour, right? I mean, there's records of this. When and who signed it in what order. So you have the exact starting date, and a computer can spit out the exact future date. The leeway that I like is the longer the cycle time, the more leeway around that date there should be. Precision is important. The final follow-up here. Precision is very important. You want the exact precision, and then you want to round around the date, because if your precision is bad, right, this is where you get into trouble. If you start your time cycle in 1976, 300 years ago, and or to a whatever, 1776. We're in the year 2000 and change, right? So 200 and whatever, 20 years ago, 30 years ago. Don't do math on live air. You want the precision to be perfect, because if you were rounding each step of the way, your key date right now could be off by 3 years. So you want the precision to be perfect, but you shouldn't expect perfection at that date and time in the 300 years later, right? But if your precision isn't good, then the day you're looking for could be off by years due to stupid rounding along the way. So the precision has to be perfect, but don't expect perfection on those dates. Give leeway. The bigger the scale, the bigger the leeway. Okay, hope that made sense. All right, next question. In Jim Cramer's book, Getting Back to Even, I have to admit, have not read it. He talks about using straddles and strangles for option trades. Those of you that attended my options webinar would know what they are. I'll briefly explain what a straddle and a strangle is. However, he also suggests that the reader use 2 different accounts to separate each side of the trade to gain flexibility. Have you tried this? What are your thoughts on doing this? Okay, so 2 thoughts here. First, let me briefly explain what a straddle and a strangle is. A straddle or a strangle, they're almost the same thing. So basically, that's when you expect an asset to move a lot, but you don't know what direction it will move in. So an example would be that FDA is about to approve for Pfizer. Let's say a company has found a secret to hair loss, right? And they created a pill, like I know Propecia is a pill for hair loss, but it doesn't really work that well as far from what I've heard. Well, I haven't used it, but if I've used it, I'd have actual proof whether it works or not. But let's say some drug pharmaceutical company made a pill that really works, like your hair would like, boom, go down to your shoulders. and they're waiting for FDA approval. You know what day the FDA is going to say you can start selling it with your patent for 3 years or whatever, or you can't. So the stock is either going to shoot to the moon or it's going to crash because no one knows what the FDA is going to say. So the best way to take advantage of this, and it's not going to be cheap because option writers know this as well, is with a straddle or a strangle. And the only difference is whether the strike price is the same or slightly different. And it's a 2-leg spread trade in the option space where if it goes up a lot, if it crashes a lot, or it goes to the moon, you make a lot of money. What Kramer is suggesting is that you have 2 separate accounts to separate the long side from the short side. I mean, Kramer is a pretty respected individual, but this is stupid. First of all, you don't need 2 separate accounts. You can buy calls and puts in the same account as a separate trade. You don't have to enter them together, though I say to enter them together. You don't have to exit them together, though I say exit them together. You don't, this is how mistakes are made. The only time you should exit a part of your straddle is when the part that you're exiting has made so much money that the other part is almost worthless, because as one side goes up, the other side goes down. So the only reason to only hold half a straddle is that you've made money on the trade. You sold the winning half, and the losing half cannot, no matter what happens to the losing half, if the losing half still has some value, the total loss of that value is irrelevant to your overall profit on the trade. And then you pray for the following. The FDA says, we approve this drug. And the stock goes up to the moon and you sell the calls for huge gains. And then a week later, the FDA comes out, we have new evidence and we will not allow this to go on. And then the stock crashes and now your other side makes money too, right? But you only held that other side because it was worthless at the time. So that's my view on it. There's no reason to have 2 separate accounts for a straddle play. If you were gonna get out half of it, because now you're speculating. If you exit half that trade, without that half making you more money than the total trade could lose, then you're speculating one-sided when your original trade was neutral-sided. And that's a bad habit to get into, and it has cost me a lot of money in the past. Very dangerous, very dangerous. So be careful. Okay, next question. Okay. Fibonacci retracements and extensions. Say I approach a clean chart for McDonald's. Sure, let's open McDonald's. I haven't looked at a McDonald's chart. Okay. All right. Oh, that's the weekly chart. Let's look at the daily chart. Wow. McDonald's is doing well. Not really sure where to put a Fibonacci on this, but okay. Oh, wait, there's sub questions. C and A, don't necessarily see. Okay. I'd start by locating the last retracement of 61% or more, which for me is the 10th. I don't think that's absolutely necessary. 10th of March. Oh, wow. 10th of March, 2003? That's kind of far back, no? Maybe you meant 2013. This is a really long-term scale, huh? Okay, so that's what you mean. March 2003. Okay. That's the big long retracement. Okay. Then if I wanted to draw, I might as well go to the monthly chart in this case. Okay, that's better. Whoa, look at McDonald's go. Am I not on a log chart? I don't know why I wasn't on a log chart, but okay, let's do this. All right, that's the big drop. Okay, that's fine. Now, where are we going from here? Which for me is okay. Then if I wanted to draw a retracement, I would start at that point and go up to the highest point to the right of the chart. And if McDonald's were to collapse, I'm ready. My issue is that these steps are too large. I agree. So obviously, another starting point could be used. I also agree. Because I don't think you have to wait for a 61% correction before finding your low. I think that's the problem. How to pick one of those points in sync with the markets. 24th of August, 2015. Yeah, that's not bad. Right there, that swing low. That's not bad. That's not a bad option. Looks good on a weekly chart. Still, the step seems too large to use for the daily. So I'll try the 2nd of August of 2018. Okay, well, we'll check that out. Okay. Oh, there's a question B. Let me separate those. But I feel lost. To be honest, it looks like I could grab nearly any major bottom and be able to get candles in line. Well, that's also correct. Like your observation is correct. Let's look at, let me see how big this correction was. 75%. Excellent. Let me put a long scale Fibonacci. See, there's nothing wrong with having both of them on the chart. Let me make this bigger. Okay. Now, remember, you shouldn't draw Fibonacci until after the price turns. So it's hard for me to draw Fibonacci here. And put it to last month's candle because the market has not yet officially turned. But if it turns, if the market turns and starts to go down, I would be looking for a buying opportunity at the 38% Fibonacci. And if it breaks the 38% Fibonacci, I would expect it to go all the way down to the 62% Fibonacci. So what you want to do is you want to grab this and you want to put it to the last swing high and maybe this one and see would it have held, or maybe that one actually, right? So here's where they turned and look how perfectly we fell down to the 38% and then rebounded from there. And then we turned again over here, and it's great when it happens on a 9. I probably would have done it on this one, but we never made it to the 38% Fibonacci. But that would have been my target. But that target was reached off of a slightly later high. You can put it to here, and we never made it to the 38% Fibonacci. But when we broke that with a nice monthly candle, it was off to the races, right? So now we can go to the weekly chart and grab a shorter time span. Oops, I typed in W. I should have typed 1W. Okay. So the other date you suggested was August 2015. Right, that's this point here. Beautiful 13, by the way. Okay. Here's your 9 to the downside that followed the 9 to the upside, broke setup trend, and it got you a beautiful 13 right at the low. Wasn't the best trade, but sequential did its job. Okay, so if I grab this Fibonacci and I put it at the low, and I bring it up to the high, right? If it's a correction, I am looking for a fall to 38%. But this was a nice high right there, and we turned, okay? We actually broke past the 38%. So that would have worried me, but this is where I would have been looking for a bounce right there. Beyond that, I can either keep it up to this high, and now I'm looking at this, but I can also move it to the next swing low right here. In which case, we once again broke the 38% Fibonacci, but we're held it right here. So that's nice. Now I can raise it up again. You can go from here, from this low in February, up to the recent high. In which case, if we turn and we start to go lower, I am looking for a rebound in the 38% zone. Okay. All right, let's get to your part two. If I'm looking at extensions and McDonald's keeps going up, when to redraw with retracements? Oh, you don't. I mean, you just keep them in mind. Like if I go to the S&P 500, I think I had Fibonacci retracements here somewhere. Maybe it's on the other one. Like when TradingView like canceled data for S&P, like so many things changed. Like if I do SPX here and I do not the CFD, but I do the index, this one. I don't know what happened. Oh, here they are. Here are my Fibonacci extensions, right? So you can see how here's my Fibonacci. I did it here from the top to the bottom, from left to right, I believe. And then I have extensions going up. Oh, I did it backwards. I did it backwards for the extensions, but it's symmetric, you know. I did it right to left, but it's the same thing. I wanted the extensions. And you can see how my first extension was right here at the high in 2015. And my next extension got so close to being reached at 3,047. Okay, so once we broke this extension, I was looking for the next extension. I think there's got to be like one more somewhere up there, and there it is, 3,009. Like these aren't really going to go anywhere, right? They're just there. And that's coming off of this last major correction, okay? And those are my extensions. I'm not moving them. They're extensions from the last crash. And they're gonna be there, you know? And once we break this, and the longer it takes to break this, the better, because the faster we'll probably move. Okay, guys? I should go back to this chart. They got their hands on data again. I got to see which one goes further. I think this one goes further. I think this is the one I should be using. I'll draw that channel over here. This is my old one. I like this better. I'll leave it here. It's the weekly. Okay, that's it. All right, next question. Tone, you once mentioned a moving average scalar. It was like two number, one for the marking highs and one for the lows. Would you tell us those ratios and which moving averages? Okay, so I think this has to do with something I mentioned once. About 15 years ago, I attended a workshop at the Bloomberg building. Bloomberg has a team of what do you call them? CMTs, Chartered Market Technicians. So Bloomberg has an entire team whose job it is to build indicators and, just build indicators basically, or teach people about technical analysis, build out the technical analysis tools on the Bloomberg terminal. These are the technical analysis experts. So these are guys like me, basically, whose job it is, they get paid a salary to come up with trading indicators. Now, the obvious troll question is, Why would anyone get paid from Bloomberg to come up with trading indicators for Bloomberg? Because if you find something, why don't you trade it and make money? Because some people would rather have a nice job and enjoy a life of no stress and not trading, and they get paid a very high salary for developing tools. One of the tools that they developed back in 15 years ago when I attended was basically percent distance from a 200-day moving average. Now, today you can say, that is so easy. That is such a joke. Why was that so impressive that someone developed a percent difference from a moving average? Well, that's because you're sitting here 15 years later. You're sitting here with full access to the internet, watching me on YouTube, right? Before the days of the internet, though 15 years ago, we still had internet, right? But the point is this, like, it's easy for you to sit here and make fun of someone who came up with the concept of a moving average, but someone had to come up with it first, okay? And there are, I think, lots of tools these days, and I think Socrates even uses one of them, that gives you an indicator of how far away you are from a moving average. And I'm sure these oscillators exist, and that's all it is. And at the time, that was a different market, right? We're talking before the '08 crisis, right? So the only big crash, there's only been like 2 big crashes in the stock market in the prior 20 years, the dot-coms and 1987. That's it. That's the list. That was it. The markets weren't this high. And over there, they had amazing success with any stock that has gone over 200% above its 200 long-term moving average. So if you, it was like, there was like, or standard deviations, I don't really remember. So there's not much I can add to it. But the tool was basically set your parameters on how far away you are from the 200-day moving average, because that's what they focused on, the longer term stuff. Okay. All right. Next question. Timestamp. Okay. Falling knives. I watched you briefly talk about it on yesterday's show. You hit some good points. But wanted more expansion on that topic. 1 second. Okay, so let's talk about it. What's the best method to determine a bottom is in, or some clues you may be reaching a bottom? That's a very good question. Let's go to yesterday's 15-minute chart of Bitcoin. This was my attempt to catch the falling knife. Notice it turned out to be right at setup trend line, which hadn't yet existed. And, ooh, let me see. I want to turn full sequential on. Nice, double 9 as I expected. So, ooh, I bet you there's divergence too. So if I pull up, say the RSI, you'll see divergence. Wow, less divergence than I expected. Maybe it's the 15-minute chart. What about the MACD? Or CMF, actually. Not that much divergence either. Interesting. What about the MACD? Wonder if it's why it's not a favorite. Huh, surprised. Why can't I give it a star? Interesting. Okay. No, no divergence either. Wow, no divergence. Divergence is a good tool. Maybe on a 15-minute chart, it's not that useful. So, first question. What is the best method to determine a bottom is in, or some clues you may be reaching a bottom? There is no best method. It's whatever method you choose that works for you and be consistent. I like the sequential, okay? I tried catching the falling knife on this 9. And you saw how tight my stop loss was. If I had waited and tried it again on this double 9, I would have still been in the profit. And I would have made up for the loss right now, okay? Would I still be in the trade? Who knows, okay? But the point is, my method is the sequential. Other people have their own methods. You can use volume. You can see how the volume has gone down. I thought there would be divergence. You know, RSI is rising, MACD is rising, CMF is rising, but there wasn't. Okay, maybe on a different time scale there would have been. Okay, so there is no best method, right? You should only attempt to catch a falling knife if you know what you're doing. Catching falling knives is only for senior traders. Only for senior traders. And also something to have fun. Like this should, of all the trading strategies you will ever use, this should be the last one, and you only do it for fun. You do it with it's a very risky trade. And you should do it with the smallest leverage at the smallest position size. This is not something to do, but if you're going to do it, have a structure. I would have just done the same exact thing I did before, and my entry would have been here, somewhere in the middle of this 9 candle with strength, and my stop loss would have been just below that bottom. And you can see how I'd still be in this trade. And we have not yet broken setup trend. I don't have to still be in the trade. I could say I'm tired of this, I'll put my capital elsewhere, right? But my strategy was to utilize the sequential. And it didn't work here. I cut my losses short, and I would have entered a new trade there, okay? Okay, more specific question. If you think you are at the bottom, 9 buy perfected candle bottom, do you front run? No, the pattern. And how tight do you set stops? I set stops pretty damn tight. Like I always like using the swing low. See, it bothered me to go long on this green 9 and setting my initial stop loss all the way down there because that's a big gap. Even in a knife catch, that's a big margin. But I would have had a nicer margin a few hours later. Would have been right here. Even if you entered late, even if you entered on a green, on a candle going above the 9, look at my initial stop loss is a lot smaller. And once we started rising, I would have probably raised my stop loss to break even. Now, here's the difference. I would not front run this trade on the 8 candle, but I have no problem entering on the 9 candle. If I enter in the middle of the 9 candle right here, and after I am up a few hours later, I set a break-even stop loss, I'm still in the trade. I'm still in this trade. Stop loss never got hit. But if I waited a little bit longer, and there's nothing wrong with waiting an extra 5 minutes, and I entered here, and then I set a break-even stop loss, you can see how I would have been stopped out of this trade for no gain. And now I'm probably not in the trade. Now, was it good to get stopped out at this price when instead you could be making money right now? The answer is, I don't know. Because by getting out of this trade yesterday evening, I could have used this money for another trade that could have made me more money than the measly, $50 that Bitcoin is up since then, $100, right? So it's hard to say whether exiting at break even is bad or good. even though you could be sitting at a higher price. Okay. Little follow-up question. What's the quick thought on entering mid-candle on that 9, just getting bullish sentiment and taking a short? Taking a shot, sorry. Let me read the question. Let me copy this question because that's a good follow-up. I won't. It's okay. So the price action. Forget the volume. I don't care. The price action. When this candle starts going up, I want to get in. It's a 9. I'm itching to get in. I see the 9. Like my fingers on the button. My fingers on the buy button. Give me strength. Give me strength. I'll buy it. Just give me strength. I'll buy it. Right? Now, I'm not interested in buying on this giant 8 candle. Because yes, there's strength in the 8 candle. But what if it goes down by the end of the candle? What if the 9 candle goes all the way down? But if this 9 candle is showing me strength, ideally at the end of the candle, not at the beginning of the candle, right? If this 9 is giving me strength in the beginning of the candle, I'm still a little concerned. But if this strength, if most of this strength in price took place in the second half of the candle, I want to be absolutely certain. The closer this candle is to completion, the more likely it will be to be a bullish 9. The higher my probability that this candle is going to end at a bullish 9, the more likely I am to buy into it. So if 80% of this move took place in the first minute of a 15-minute candle, I'm still cautious. But if this candle is down here and 10 of the 15 minutes have passed, and now I see it arising, and I'm saying to myself, well, the majority of time in this candle has passed, and it's still rising, and it's starting to get bullish. I want to get in, okay? So it depends on when in the candle this is happening. The later in the candle this is rising, the more confident I am in buying on the 9 itself, okay? All right, cool. There's more follow-ups on this knife catch. Let me see if I can go through them quick. Do you never front run patterns, 7s or 8s or 13s with perfect candles when a good idea to front run? I don't mind front running a pattern, but I lower my risk and position size. So I want some skin in the game on the trade, but not all the skin. So I am either, let's say I want to, and we talked about this a lot in the risk management webinar on position sizing and leverage, where if you're going to front run, you know you're doing something that goes against the rules. So the moment you do something that's against the rules, you want to lower your exposure and your risk. So if your intention is to put $1,000 on this trade, but you're front running on a 7 or an 8, you may only want to put 1/3 of that money in and then add the rest at the proper time. 9s with non-reversal or non-perfect reversal candle. Same thing, right? If I'm entering on a 9 or the candle after a 9, but it's not a perfect reversal, and I still think that's my best shot, if it doesn't look like a perfect trade, I would lower my position size, okay? And lower my risk, lower my leverage. 9s and 13s, same thing, you know, if there's a trend line, like look, if we break this setup trend line, I become more bullish. I become more bullish if we break the setup trend line. Like right now, if I had entered my long on this 9 and I did not get my stop loss hit and I'm still in this trade, I would potentially add to that trade above the risk line if we're breaking the risk line. The big question becomes, do you add it the moment you're breaking the risk line, or do you add it do you wait for the candle to close? And I know there's another question on this coming soon. Well, it depends. It depends. Am I breaking the risk line in the beginning of the candle, or am I breaking the risk line at the end of the candle or in the middle of the candle? And I can give you a reason for both of them. Basically, here's the thing. If I'm breaking the risk line at the end of the candle, I am very, very, very confident that we're going to go higher. Okay. Now, this is only a 15-minute time frame. You know, every time frame that's greater than 15 minutes trumps this time frame. But if I'm breaking in the beginning of the candle, I'm kind of gambling, thinking that I don't want to miss the big move, which is why if I have no skin, if I have no trade here, I would actually consider going long as I see strength breaking this, breaking the setup trend line. But if I already have a position here, I may wait till the second half of the candle to make sure we are more likely to close above setup trend. I've just seen too many reversals mid-candle. So just use caution. How much risk? I have a real bad tendency to set up stops real tight when chasing a falling knife. That's a good plan. There's nothing wrong with that. You shouldn't be chasing a falling knife. That should only be done for experienced, profitable traders. You should not chase a falling knife if you're still new to trading. I mean, you saw what I did with mine, and I would have said I like setting stop losses below swing lows. And in this case, I raised it up to the 9 candle low, which allowed me to enter at a better place. Not double down a losing trade, but enter a new trade at a better price. How many times should you retry to capture a trade you believe is bouncing? That's a good question. I've never had that before. When has a trade gotten away from you? For example, if you watch a 9 that comes 100, then the candle rips to 120. Does it make sense to enter on the 2 candle 121? And where do you set the stop? I've had I've had crazy trades run away from me, and it's unfortunate, but it happens. You just, you know, move on. It's a trade that got away. It happened to me on GBTC. I wanted to enter GBTC, was trading at $200 a share, and I put in a limit order for 190 because I thought it can like pull back a tiny bit and enter me at 190. It was a pretty illiquid stock, and the next day it was 210, and the next day it was 220, and the next thing I knew it was 5,000. So that was a trade that I really regretted, and it got away from me. And it got to like 220 the next day or something, or 210 to 20, and I didn't want to chase it. And you know what? It's okay because I didn't lose any money. Anytime you don't lose money, you shouldn't regret it. Okay. I've gotten beyond being upset about missing a trade. What bothers me is trades that lose me money. There's always another trade coming. And that's and the reason why I don't like to chase is because if I have to, because my rules tell me I have to set a stop below the swing low, and it really hurt me yesterday getting in over here because my stop loss was so far away. I would have been a lot happier with this situation because my stop loss would have been a lot closer because the swing low was closer. Okay. All right, let's move on. Next question. So we're 1 hour and 54 minutes in. Mid-range entries. Okay, here we go. When in consolidation after a breakout or breakdown, what do you look for to join the caravan upwards? Well, right here, right now. Right here, you see, I am eyeing this right here. I like the break of setup trend and moving average. It's about to happen, right? So right here, what I want to do is I want to enter it. How much time we have in the candle? We have 10 minutes left in the candle. Would have been nicer if it was 5 minutes left, but I'm going to enter right here. So what I'm going to do is I'm going to set, let's say, a stop limit order at 10,440 to enter me under 10,450. So that means I got into this trade. I got into this trade right now. I'm joining the caravan. I'm entering. I'm pre-running this. I'm anticipating the break of setup trend on this candle or the next candle. Ideally, I want to wait till next candle, but we're going to move on to the next question. So I just entered the trade, and we'll try to keep an eye on it, right? I like the fact that we have just made a new swing high. Granted, there were two other swings that were just as high. And I have a feeling this candle is going to close up here. Where would my stop loss be? Now, stop losses on breakouts are trickier. And that stop loss, oh, I don't need a new line. That stop loss would be probably at first somewhere in this vicinity. Notice I am just below the swing low, and I'm also just below the moving average. I'm giving myself a little bit of leeway here, okay? I entered it a little bit prematurely, but that's okay. Ideally, I would have loved a close right at setup trend, and then next candle going long as it breaks it, but that's okay. I believe this is looking bullish to me, and it's going to break out. So I just entered my long trade. That's my stop loss, and we'll keep an eye on that. Let me read the rest of the question. How do you trade flag patterns? Well, this is similar to that. Oh, actually, it is a flag. Not a flag, sorry. This is a triangle. This is perfect. Let me show you. I can grab a triangle, and I can draw it. Right here. Right here. In fact, I should have entered a little bit earlier. Damn, it's hard to draw because of the magnet. Right there. Okay. I'm within my rules. This candle went a little bit, you know, far to the downside, but this is a nice triangle to me. Cheating a little bit. It's a 15-minute chart. You know, they're not perfect. But right here, you know, there's my triangle. And I like this breakout. So I want to enter anywhere right here. Anywhere above. Now that we're getting to the last couple of candles of the triangle, maybe I enter a little bit early. Maybe I could have waited some, right? But I can always add to that position. So if this thing breaks out, you know, at night and not today, right now, I can add more. But this is where I want to enter as it breaks out of this triangle. I like this triangle. We'll keep an eye on it. And there's my stop loss. It's the last swing low. If we go back to the bottom of the triangle and then go back up to the top of the triangle, I will be raising that stop loss to the new swing low. But right now, that's my swing low. Okay, let me finish reading the question. Do you watch the breakdown or breakup candles? Are they important to your chart? Absolutely. Like the moment I have a feeling that this candle is going to close above the triangle, I want to be in that candle before it closes. I don't want to wait till it closes, because if this candle breaks above the triangle, it can run away like really, really quickly. And I've seen that happen too many times. I want to be in that candle, okay? Even if I would have entered 2 candles earlier as we were breaking that triangle, the stop loss would be the same and I'd still be in that trade. So I'm okay breaking above this triangle and taking the long trade. I wouldn't double down this quickly, but if we pull back, and then I wouldn't mind doubling down at the end of the day if you planned for a potential double down. All right, follow-up questions. Again, how do you watch consolidation patterns for potential breaks up or break down? Some patterns, for instance, consolidate 20%, some 50%. When do you just walk away? Basically, when you find it, when you see it. Like, I didn't know this was a triangle until I just, like, you know, leaned back a little bit and saw it. I wasn't even looking for a triangle. I was like, hey, consolidation is going to break the setup trend line. And then I stepped back for a second, like, wait a minute, this looks like a triangle. And this makes me even happier into the bullish trade. Okay, I got a little follow-up question. Regarding flag patterns, I'm not a huge fan of the flag patterns. So we can safely say this is a bear flag. What's the mental thought of going long versus waiting, waiting to see this flag break down? I don't like flags, guys. And if you're going long, what's your expectation of tops? I don't like flag patterns, guys. I like triangles. I like triangles. And so here, so if I take this and I see how far it goes down, and that is 162 bucks. So it's about that. So that's what I'm looking for. That's my target. That becomes my target. I should put it right here because that's where we entered. That's the target. Okay. Flag patterns are similar. Flag. Because these are the kinds of flags that I like. I like these and these a little more. These are just so subjective. It's just so subjective. They're just pullbacks. I'm just not a fan. It's just a pullback. I have other metrics. No, just not a fan of flags, guys. Sorry, let's move on. Breakouts. Okay, so continuing with the same topic. We are at 2 hours and 2 minutes. Let's talk about breakouts. Breakouts. These freak me out because they are already at the top. Something like Starbucks, which is already so high. I've heard you mention a 2 over a 1 over a 9. How do you limit your risk or convince yourself or even manage risk when it breaks out? Good question. Also, how do you trade? How do you trade it if the candles seem to be squeezing or losing momentum? How do you make that assessment? All right, let's go take a look at Starbucks. Somewhere here. Oh, forget it. Okay, so Starbucks. Starbucks is different than that other stock. Oh, this is the weekly chart. Let's do the daily. I need pullbacks. This is gorgeous. Look, right here, right? Yes, Starbucks is at a new all-time high, but look at this pullback. And then it gives you a reversal candle and a 9 right at the pullback holding setup trend. This is where you buy. You break of setup trend, you go to new all-time highs. That just gets you more confident. Again, you hit a 9 and you consolidate it. When you consolidate, that's when you buy. Right here, this is not, so this was a 9, and this was a new run up to a 9, but this is this here, I would be a little bit cautious, okay? So I'm comfortable buying it here. I may even add at all-time high. I'm also comfortable buying here. I'm not as comfortable buying up here because now I've already assumed I've made money. So this is a little toppy to me. But now we're consolidating. So if we go to a new all-time high, then I'm interested in buying. Like same thing here. Like this was a nice consolidation. So even if I wasn't long going into this first 9, I'm perfectly okay buying this green 2 going above this green 1 above 9 because it's the first 9 in the series. I am less enthusiastic of adding money to Starbucks at this green 2 above this green 1 above this 9 because now that's the second 9 in the series. I'm less likely. It doesn't mean I'm not going to do it, but I'm less optimistic. I'm less confident. If there was another 9 like there was up here, I'm even less confident. But look at this consolidation and pullback. Now I'm confident again here, and I'm confident here, but I'm not confident up there. Does that make sense? That's the difference. It's not about whether it's at an all-time high or not. It's about whether it has consolidated and pulled back and created enough momentum to go higher. And the next time it goes to new all-time highs, or the next time it breaks $100 based on a pattern, I might be interested, okay? You can also go to a higher level time scale. You can go to the weekly chart. If the daily chart is scaring you about how high it's gotten, go to a higher level time frame. Here's a higher level time frame reaching its very first 9 in the series. Well, no, I'm sorry, there was one back here. Okay, here's a beautiful 9 buy on a weekly time scale. There's your very first 9 that did not break setup trend and gave you a reversal candle. This is a high probability pullback to the downside, but it didn't happen. You had 1, you had 2, and boom, there's your red 3 breaking setup trend, breaking the 9, and this is why you got to get in on this trade in the beginning of the candle, not wait for the candle to close. Because if you wait for the candle to close, now I would not chase. If I did not buy Starbucks in the beginning of this candle at $60, I am not going to buy it at 65. Either you catch this trade at the right time or you let it go, and the next time you have a buying opportunity is this green 2 going above this green 1. Okay? But then it gets to another 9, it has a pullback, and now I'm confident in getting in. It got to another 9, and look, it's been consolidating for 5 weeks. I'm happy to get in again on a green 2 above a green 1 above the 9. I have no problem with that, as long as I had a pullback. It's, if we look at another stock, I think it was CBOE. Look at this. Look at this. This is 1, 2, 3, 4, 5 9s in a row. Weekly chart. Weekly chart. 5 9s in a row. And look, missed it by 1 candle, missed it by 1 candle. This was almost 7 9s in a row. If these 5 candles were slightly smaller, this would be, it was all about the 5 candle, right? Like this 9, all I had to do was close above the 5 to get you a 9. This red 1 had to close above the 5. If these 5 candles were 20% smaller, this would be 7 9s in a row, okay? No pullback whatsoever. Am I confident in buying this green 2 above this green 9? Hell yeah. Am I confident buying this green 2 above this green 9? Probably, because it's not going up crazy fast. Am I comfortable buying this green 2 above this green 9? Probably not. Am I looking to short this 9? Hell, I am. Never gave me a short trade, and I'm shorting this one if I'm paying attention, right? So it really depends on how far of a run-up you are at. Look how far you are from the 200-week moving average here. So it really depends on where you are within the 9s. I think I answered them all. There are follow-up questions. I'll read them real quick, but I do want to move on. Again, how do you know when you're just chasing? I think I answered that. Or when it's a breakout has gotten away. I think I answered that as well. And if you still want to enter, how far should you set your stop loss? Here's the problem. your stop loss should not change based on where you get in. It shouldn't. Let's go back to that Bitcoin example. And look at that. Look at that breakout. Look at that. Beautiful. Yes, we're pulling back, but look at that breakout. That's what I wanted to see. Look, no matter where I entered on this 9 candle, my initial stop loss should be below the swing low. No matter where I entered this 9 candle, my stop loss is going to be below the swing low. It doesn't matter if I enter this trade for the breakout here on this 3 or here on this 3. It doesn't matter. My stop loss is going to be here regardless. But here's where it matters. When it's time to set your break-even stop loss, obviously, the higher you enter, the higher your stop loss is going to be. This is why if I had entered in the middle of this 9 candle, I might still be in the trade. And if I entered on this 1 candle going above the 9, I probably got stopped out, but that's because I have moved my stop loss. In addition, you shouldn't move your stop loss until you've profited more than what you were risking. And if your stop loss is far, you're less likely to move it to break even sooner. But it has nothing to do where your initial stop loss should go. Okay, next question. Timestamp, 2 hours, 11 minutes. Okay. Let's take a look at the S&P for a 1 to 5 year outlook on the S&P. Here's the S&P. My 5-year outlook for the S&P is the next Fibonacci retracement. If you look, we came to the prior Fibonacci retracement right here. We came up just shy, like we just did. We got here in May of 2015. We broke it in July of 2016. So let's say that's 1 year. How long did it take us to reach the next Fibonacci retracement or close to it? So if this is July 2016, this is August 2019, so 3 more years. So we're talking 4 years between these 2 lines. I don't see why that can't be replicated. So I'm looking at 5 years from now to be around 4,000 points on the S&P. Can there be a correction? Yes. And we had a correction. We had a correction earlier this year. It's a pretty nasty one too. Almost got me bearish the S&P 500. But we held the long-term moving average. So my 5-year, 1 to 5 year outlook is 3,000 to 4,000 points on the S&P, maybe even higher. I am very bullish on the S&P with Trump's reelection. Now, if Trump doesn't get reelected, you can scrap everything I'm saying. Like Trump can have a heart attack. Who knows, right? Some dark horse socialist candidate can come out of nowhere and beat him. Is it likely? No. Is it possible? Of course it is. Okay. So a lot of it depends on Trump's reelection. But at the moment, my outlook for the S&P is bullish, but I can easily change my mind. Now, you're also asking for BSC, which I believe is the Indian stock market. So let's go and take a look. I should have indices here. Do I have BSE? I wish flags were here. Let me type it in here actually. BSE. Yep, there it is. Sensex. Oh, okay, probably. Yep, I had it there. It should be at 36. It should be at pretty much at 3,700. And it is perfect. Okay, so this is the Indian stock market on a weekly scale. It's holding setup trend. I like it here. It's pretty bullish to me. It's still rising. It's in an uptrend. We can look at the daily chart. Daily is not looking great, but the analysis is going out 5 years. So I'm going to zoom out. you're not going to like the but that comes with this. The Indian stock market looks very, very bullish to me. But that doesn't mean that the Indian stock market is going to outpace the inflation of the Indian rupee. I believe that the US stock market will outpace the inflation of the US dollar. But it's hard for me to... I'm not worried about the Indian stock market. I'm a little worried about it because India doesn't... I mean, they're cracking down on Bitcoin. They're not exactly free market. Like, they're not allowing their companies to thrive in the capitalistic environment. So that's a concern. So would I rather be in the Indian stock market than the US market? The answer is no. If India was a little more, private sector friendly, I would change my mind. So the weekly chart got a 9, but this 9, I don't like it already, right? It's choppiness after the 9. So if it gives me a green 2 above a green 1, it's a new trade to the upside. But if it starts to go lower, then it's a continuation trade off the 9 into the countdown phase. I am bullish the stock market, but that doesn't mean it's going to be profitable. All right, next question. Let's talk about some interest rates. We're going to take a break in a little bit. I would want to get through some of these questions, actually. Let me close some of these ones. Clean it up a little. Okay. All right. What basically leads to negative interest rates, and how long can they last, keeping in mind that negative interest rates are technically insane to think about. Like, what problems cause interest rates to go negative, and a country like India has a fixed deposit rate of about 7% and borrowing rate of 10%. Is that good? Okay, so I'm going to answer the second part first. Okay, India has a borrowing rate of 10% and a fixed deposit rate at 7% because it's keeping up with India's inflation. All right, so I'm pretty sure that the reason why this is happening is because your currency is losing 7% of its value every year, okay, or close to it. Maybe it's losing 5% of its value every year, right? So it's all relative. It's all relative. The one country having a 1, and this is going to lead into your next question. A country having a 1% interest rate and another country having a 10% interest rate. If the country that has a 1% interest rate, the inflation in that country is 0, you get more by putting your money in a bank and getting 1%. But if a country has a 15% inflation rate and they're giving you 10% interest rate, you're still losing money. You're better off putting that money into a country with a 1% interest rate and making 1% on your money in purchasing power than getting 10% on your money, but still losing 5% of your money in purchasing power, okay? Not to mention, a country like India one day decides to cancel your large denominated bills. And now, how much of your money is lost running around from bank to bank converting dollars, right? Like, you got to factor all of that into account. Don't think of it as two identical people, one putting their money at 10% and the other one putting their money at 1%, and they have the same risk and the same inflation. That's not true, right? Like, the interest rate in your country adjusts for inflation and risk, and the risk of the government and the risk of the country and the risk of the currency and political risk, and another country is going to go to war with them risk, okay? So a country giving you a negative interest rate is not, I mean, it's the biggest challenge to a negative interest rate is Bitcoin. Because Bitcoin is an asset that doesn't charge you anything to hold it, and it's supposed to increase in value, and it's unconfiscatable, and it's easily liquidatable, okay? Now, gold doesn't have those things. It's hard to spend gold. It's hard to move gold. It's hard to save gold, right? You can say, I am not going to pay. Here's the stupidity of the situation. I cannot believe the government is forcing me is charging me 2% on my money. I'm going to save my money in gold and not pay the government 2% a year. But what if it costs you more than 2% a year to hold the gold? Then who's being stupid, right? You would have saved more money by allowing a negative 2% interest rate. Because what if it costs you 4% to store and protect the gold, right? You got to go buy a safe if you're going to store it yourself. If someone else is storing it for you, that's risk, and you have to pay them for the storage, right? Like you're like, I'm not gonna let the government hold my $10,000 and pay them 2%. So what's 2% on 10? Let's say it's what's 2% on 10,000? $20, right? No, $200. $200, right? I'm gonna let government hold my $20,000, and they're gonna charge. Let's say they charge you 1%. They're not gonna go way negative, right? 1%. $100. It'll cost you $100 to hold $10,000 at a bank. And you say, this is ridiculous. I'm going to put my $10,000 in gold. So first of all, you're going to pay a 1% fee to buy the gold, okay? So $10,000 worth of gold is going to cost you probably more than 1%. I remember my guy used to charge me $60 per ounce, right? So an ounce was, let's say an ounce is $1,500 and he charges you $60, right? So what is that? What percentage is that? That's more than 1%. That's if you buy an ounce. So let's say $1,500 and he charges you 60. That's more than 1%, right? So you're already losing money by buying the gold. Then you have to go out and buy $1,000 safe. You know, just think about the ridiculousness of the situation, right? If the purchasing power of the dollar does not drastically decrease, then it will take you like 4 or 5 years of holding that gold to recoup the 1% drop, the 1% fee that the government takes from you by holding it at the bank, right? But of course, with gold, you don't have the political risk, you know, things like that. So there's pros and cons to everything. You can't think of this stuff in isolation, okay? How long can the government keep negative interest rates? As long as they like, as long as inflation is low, right? So what do people do? They buy houses, they buy gold, they spend more money because that's what the government wants. The government wants you to spend money. They don't want you saving money. They want you to spend it. But if you go out and buy a car, you just bought something that is losing 20%, not 1%, right? Like you really have to consider it. You really have to consider your pros and cons of these rates. And just because one country is giving you 10% is irrelevant if it costs you more in the long run. Okay, next question. Also interest rates. So we'll stay with the topic. Countries that have a very low interest rates and have some and you have family there and other members live in countries with high interest rates, does that cause an arbitrage to be used in interest rates? No, it doesn't. It really, really doesn't. Because unless it could, if it so happens that the country that is giving you a higher interest rate has a more stable political system and more sound money and less risk of holding that money, then yes, it's a huge arbitrage system. It's a huge arbitrage play, but that's very rare. You have to know both countries very well. Like in this case, if you feel that your money is safer at an Indian bank earning 10% than it is at an American bank earning 1%, if you think it's then yes, then you can borrow money in America at 1% and put it in an Indian bank and earn 10%. But if the Indian rupee falls 20% against the dollar, you're screwed. Like you just lost more money than you gained, right? Did you see my Argentinian pesos example? I like to leave a country with local fiat of that country because I don't know when I'm going to come back to that country. I can come back to that country in 4 months, and I want to make sure that I have enough taxi money in my pocket. Because what if I land at 3 in the morning? You know, I want to make sure I have some local fiat. But I did that with Argentina, and I left Argentina with $80 worth of pesos, and now they're $20 worth of pesos. And no one is going to accept my Argentinian pesos in the US. And next year, it could be $10 worth of pesos, right? So what if I could have earned 10 to 20% on those Argentinian pesos if they dropped in value by 80%? Like, who cares? And that's why these arbitrage plays are very, very dangerous. It's not about borrowing from a low rate country and putting it in a high rate country. It's more about where are you storing that money, and how likely is it to get devalued or canceled? Like the one reason, the biggest reason why the US dollar is the world reserve currency is not because of the US military. It's because the US dollar has never been canceled. If you find a US dollar bill from 150 years ago, it is probably worth more today. Do you know what happens if you find a 100-year-old bill from any other country? It's trash. That's the difference. That's what makes the US dollar the world reserve currency. Even the British pound was canceled not that long ago, okay? That is what makes it a world reserve currency. If some guy in Europe inherits their family house and they find a suitcase full of US dollar bills, not only do they have collector value, they have collector value because they still have real value. Okay. Next question. Again, sticking with interest rates. What do we got on time here? 2 hours, 6 minutes. Mr. Powell, the Federal Reserve Chairman, says there is a new macroeconomic landscape: slower growth, lower inflation, lower interest rates, lower neutral interest rates. Consequently, Fed is updating policy framework to deal with it, and meaning new tools, as the old tools will not work as well. What are your thoughts on how this will play out in stock markets? I think growth stocks will continue to outperform value stocks, as growth will be harder to find in a low inflation environment. Look, the job of the Federal Reserve Chairman is to keep the markets calm, is to keep everyone happy, is to the job of the Federal Reserve Chairman is to cheerlead the markets. The job of the Federal Reserve Chairman is no different than the job of Anthony Pompliano talking about Bitcoin. Okay, that's his job, to basically pump Bitcoin, and Powell's job is to pump the economy and make everyone feel comfortable with the economy, and they'll never admit it, but keep the stock markets rising. And he has to explain the fact that interest rates are low and they're lowering them. And they will say anything and anything, including it's a new environment, and lower interest rates in this environment are normal. So I wouldn't listen to what they say. I would just watch how the markets perform. And you know, the more comfortable people are, the more confident they are, the better everything is. Can growth, honestly, I don't pay attention to growth stocks versus value stocks. This is not what I do. I'm a TA guy. I look at TA and I try to look at global macro trends, and the macro trend tells me we're not ready for a recession yet. And yes, I know the yield curve kind of flipped, and I need to do a little more research on that. Okay. Reason why you think the euro will eventually fail, and what actually causes a currency crisis. So once again, for all your information about the euro, please read Martin Armstrong's blog. They have a search feature. He's written so many good things about the euro and why the euro currency has been flawed from the beginning. I'm sure he mentions it often. Oh, currency that expires. How about that? Interesting. One of his recent blogs. I'm sure he talked about this. U.S. currency has never expired. That's what makes it unique. Yeah, I really got to start reading this blog again. It's really good. Like his understanding of economics is really amazing. Maybe I'll start today. So it's a long-winded discussion about a currency crisis. Actually, no, it's not. It's very, very simple. A currency crisis is when the people lose faith in your currency, mostly your own people. Your own people are the last people to lose faith in your currency. Like the Argentinians are the last people to lose faith in the Argentinian peso. Everybody else has never had faith. Like I am the only idiot that had faith in the Argentinian peso because I left Argentina with $80 worth of peso, okay? I certainly didn't leave Argentina with $80,000 worth of peso thinking they were a better store of value coming to the US than US dollars, okay? So your people are the last ones to lose faith. Now, the most trusted currency around the world is the US dollar. Eventually, right now, the world loves the US dollar. The world will start to lose the faith in US dollar first. When less people around the world, when non-Americans stop hoarding the US dollars, the US dollar will start to have an inflation problem. And then when the Americans start to lose faith in the US dollar, that's when we go to a hyperinflation phase. It's all about confidence in your currency, okay? That has nothing to do with the euro failing. Now, do people around the world have faith in the euro? They do. Do they have more faith in the euro than the US dollar? They don't, okay? That automatically means that according to a consensus and general free market, the euro is more dangerous than the US dollar. The two critical flaws of the euro are twofold. One, when the euro was invented, the debt was never consolidated like it was in America. So each country has its own independent debt. And you've seen the European debt crisis in 2011 and again in 2015, and you're probably going to see it again. The other problem with the euro is that the people of Europe, they're more loyal to their own country. They have their own languages. They have their own cultures. They don't intermix. America is referred to as a melting pot. In America, Italian Americans marry German Americans. You don't see a lot of Italians marrying Germans in Europe, right? Same thing, Greeks. Like everyone is something American. Greek American, African American. It's a melting pot. We have the same language. We have the same culture, even though you can call it a culture, you can call it whatever, right? It's one language, it's one general culture. Holidays, each state doesn't have its own holiday. Each country has its own holiday in Europe, right? Europe is not a melting pot. Everyone is independent. Germans stay in Germany, Italians stay in Italy. Mostly. And that creates a problem. That creates a cultural problem. The senators from states, they don't argue about cultural issues. They argue about social issues. They don't argue about cultural issues. And that's a flaw for the euro. Both of these things are flaws for the euro. It was poorly constructed, and eventually each countries want to be in control of their own money. And they'll use the crypto meme to deal with it. Oh, I forgot to timestamp this one. Bam. Shit. I'll do 235. Probably talked more about the other one. 240. Okay. Next question. Okay, so for real estate questions, I'm not an expert. I'm certainly not an expert at the Indian real estate market. I know nothing about it, okay? So I have absolutely no views on the Indian real estate market. I guess I can take a look at some stocks that are builders. I am kind of curious. So let me see here. DLF Limited. This is the weekly chart. That is not a good looking chart. It's not bad, but it's not great. It isn't a monster downtrend. Oh boy. Yeah, that's not a very good looking chart. It looks like it might have finally bottomed on a weekly scale, but it's not great. Let me look at another one. This is an index. This is not bad. This looks better. This looks cleaner. This is looking pretty bullish. So the properties index, I'm assuming, is not that bad. This one is also not bad. So maybe that stock isn't doing too well. But this one is doing much better. Not too bad. I can take log off. This one not too bad. Look, the best metric for real estate is property laws. How good are the property laws in India? How likely and how good is insurance, right? Like, is there insurance? Like, if you buy a house in India, and what are, how easy is it for the government to take it away from you? How likely are you, like if there is a landslide or an earthquake or your house gets destroyed, how likely are you to recoup the value of that house? How much is that insurance? Okay, so a lot of that's the biggest factor. For me, I would never buy property in a place with bad property laws. I just rent, okay? That's the biggest factor. I don't know enough about the Indian market to say. Your next question is more interesting. Views on the Australian real estate market, okay? So we're gonna take a look at one more ticker for the Australian real estate, AXRE. That's, oh wait, that might not be it. No. Australian. I don't know if there is an Australian real estate index. So I don't have the numbers. I can't look at the chart, unfortunately. But what I can say is, when I was in Australia, I went to a lecture by Harry Dent. And he's the real estate expert. Okay. And I kind of wanted to bring him on the podcast. And he specifically is very optimistic for Australian real estate over the next 10 years. He thinks it's short-term overpriced, but long-term undervalued. So he believes that the only markets that have a good future in real estate are Australia, India, and Africa. Now, but he does not recommend India and Africa because of the other things I mentioned. Property laws, political laws, things like that. And he thinks that Australian real estate has the best future upside. And the reason for that is he believes that over the next 10 to 20 years, Australia will attract the smartest immigrants from around the world. This was what made America great, the fact that America was attracting the smartest and the brightest. And his demographics, his demographic research is pointing him to Australia being the #1 gatherer of the brain power from Asia. He doesn't see the smart Filipinos and the smart Thai and the smart Chinese moving to America 10 to 15 years from now. He sees them as finding a home in Australia. And that creates more population growth, that creates more innovation, that creates more value for your country, and that certainly translates into a rising real estate market. So he had a very good lecture talking about all of this, and it made a lot of sense. So my advice is check out Harry Dent's work and see what he says about the Australian real estate market. All right, now we can take a look at currencies. And then after that, we'll take a little break and I'll regather, because we still have a lot of questions. Okay. So you forget the timestamp. 2, 5, and okay. You know what? I'll lower these. Sorry, guys, 1 second. Oh, that's what happened. Okay. All right, next question. And this is, let's take a look at the currencies. I believe I have the US dollar versus the Indian rupee rate. It's not looking good for the rupee. Look how it topped on a 9. This was, by the way, a weekly 9, a monthly 9, I think, and a daily 9. And somebody I know took that trade. I think that's what it was. Yep, there's a daily 9 right up there. My one of the programmers for the sequential is in India, and he was all over this trade, the Indian rupee short. Sorry, the Indian rupee long, where rupee was appreciating against the dollar. It's not looking good. The rupee looks like it's depreciating against the dollar, and this is why it's dangerous to leave your money in India earning 10%. Now let's look at USD against the Australian dollar. The Australian dollar, whoa, not good for the Australian dollar. This is looking nasty. So that's not good at all. The Australian dollar has taken a monster hit. It's down over 30% against the US dollar, and I don't see it getting any better. I don't know if this is because Australia is printing too much money. People in Australia starting to lose faith in their currency. People around the world losing more faith in the Australian currency. Whatever it is, it doesn't matter. But this chart is not looking good. That is a nice weekly candle. It has done good this week, but it has to do a lot more. I would need to see the Australian dollar like go above the setup trend line in order for me to take it seriously at this point. Just made a new low, just not looking good. So if you want to cross between the Australian dollar and the Indian rupee, they're both falling, and so they're going to be, they're both falling right now. So they're pretty steady. Right here, the Australian dollar was appreciating against, it would cost 64 rupees to buy an Australian dollar. So this is where the Australian dollar is appreciating against the rupee, and now the rupee has been doing better, but it's been flat for the last few years. So not very interesting to me until it goes above 53 or it falls below 45. So you have a range from 55 to 45. As long as it stays in that range, they're both just going to be losing value against the US dollar. Okay. All right, let's take I think it's time for a break. Let's be back. There's just a 5-minute break. Let's be back at the top of the hour. I know we're 3 hours in. but I have a few more questions. I'll try to go another 30 minutes and try to cover your questions. All right, pausing recording, back in 5. Oh, I moved my T. There, we are back. The recording started. Okay, let's get back to the questions. Timestamp. You talk about the price action in relation to past halvings. What should a trader look for in the short term before the next halving? We don't have enough information, guys. I'm sorry, we've only had 2 halvings. And if you just look at the monthly chart, you can see how going into the first halving, it was just flat. This was going into the first halving. The first halving took place at the very end of 2012. That was the first halving. And it started to rise right after that, mostly because like people did not speculate going into the halving because they were actually concerned. Let's make sure the halving actually works, you know, that the code functions properly. For the next halving, this big run-up took place leading into the halving. And this was the week of the halving, and then we fell after that. So there was lots of speculation in a run-up before the halving. Now, we just had a big run-up. Was this premature speculation going into the halving? And if it was, we could be pulling back into the halving. We could also pull back some and then rally one more time into the halving and then actually go down on the halving. So it's just too early to speculate. We have to wait until early next year in order to really see the potential effects of the halving. Yeah, a lot will depend on the following. Are we higher than 10,000 going into next year, or are we way lower than 10,000 at the end of next year? But right now, it's I don't think it's possible to know what effect halving actually has. All right, let's move on. Does fundamental analysis help de-risk a trade when used with TA? Do you need fundamental analysis? I think you need some fundamental analysis. Like, for example, fundamental analysis tells me that Ethereum is garbage. Fundamental analysis tells me that Litecoin is garbage. Fundamental analysis even tells me that silver is going to lose its monetary property over time. So fundamental analysis tells me that, yes, people speculate in silver, and that's where technical analysis comes in. But fundamental analysis tells me that whatever premium silver has as being money, that is going to deteriorate over time. Now, whatever premium gold has for being money, that's not going anywhere, okay? Same thing with Bitcoin. Fundamental analysis tells me to hodl Bitcoin. Fundamental analysis tells me to not to hodl Monero or Litecoin or Ethereum or anything else. So fundamental analysis tells me what's dangerous and what isn't, okay? Fundamental analysis tells me that I would rather be long US stocks than foreign stocks, even though foreign stocks may outperform US stocks. Fundamental analysis tells me that if I'm gonna, store cash in my drawer, it should be US dollars and not Argentinian pesos. That's fundamental analysis. And it complements technical analysis because it tells you that at least you won't lose everything and go to zero. So I use fundamental analysis on a big, large scale. Do you need it? I think you need the large scale fundamental analysis. I don't think that you need the short-term scale fundamental analysis. You do need to be aware of the news. Like we talked about with Tilray, the marijuana stock. Like if you're going to be in marijuana stocks, you really should pay attention to the legal laws and what's going on with the legality of marijuana. So when we were on the show, we talked about the potential of marijuana stocks in Canada finding a bottom because of fundamental analysis that the laws are going to change. And they're going to be more friendly to the marijuana sector. So that's your fundamental analysis. But as far as entries go, I still believe in technical analysis is way more useful. All right, next. What's the most important thing a position trader needs to focus on? Honestly, I think as a position trader, fundamental analysis becomes just as important as technical analysis. The lower your time frame goes, the less fundamental analysis is important. So while I would say fundamental analysis is as important as technical analysis when it comes to weekly candles and position trades, technical analysis is more important to me on a daily scale if I'm aware of news events, because news events are not fundamental analysis. News events are news events. So, so that's kind of my view on it. That's it. It's a combination of fundamental and technical, 50-50, in my opinion, when it comes to a position trade. Like Bitcoin is a position trade. I wouldn't be long Bitcoin if it wasn't for fundamental and technical analysis. Technical analysis tells me that it's long-term bullish. Fundamental analysis tells me that it's long-term bullish. I'm looking to make a position trade, okay? If we look at Ethereum, for example, technical analysis can tell me we're bullish. And I'm happy to buy into Ethereum and profit, but fundamental analysis always tells me that Ethereum is bearish. So that means I would not use weekly charts in Ethereum to enter any trades. I would only use daily charts. I can go long or short, but on a long-term scale, I would never have a position trade. The only time I would have a position trade is if I'm bullish fundamentally on the asset. All right, next. Can a full-time retail trader be as good as an institutional trader? I'm assuming that word is institutional. Yes, you can be better than an institutional trader as a full-time retail trader because you're working with smaller capital. When you work with a smaller portfolio, it's a lot easier to make more money in percentage terms. When you're working with a $100,000 portfolio, it's actually reasonable to make $50,000 to $100,000 in 1 year. When you're working with a $10 million portfolio, it's very, very difficult to make $5 million to $10 million in 1 year, okay? So on a percentage basis, a retail trader should be able to outperform an institutional trader. If you can't, then you probably should not be a retail trader. It's a bad job for you. If you're a full-time retail trader, you should be able to crush an institutional trader by percentage. Because the institutional trader makes his money from the management fee of the money. He just has to outperform the S&P 500. You as a full-time retail trader, you have to crush the S&P 500. Otherwise, Why are you doing it? Otherwise, you can leave your money in the S&P 500 and go work for a living, okay? So you're supposed to crush the institutional trader. And that's why a lot of retail traders don't want to be institutional traders. They're not looking to just beat the S&P 500. They want to do well, but it doesn't scale. And eventually, if you're a retail trader that grows his account, eventually you become like an institutional trader. You can't make as much money. But that's the goal. That's the goal. All right, I think all right, anyway, I'll have to timestamp later. All right, I'll take a look at another stock. No idea what this is. Innovative Industrial Properties. Ooh, that's not good. Still bullish, but the weekly scale is not good. It tops on a combo 13 along with an aggressive 13. Was still in the middle of its sequential. And as long as sequential stays above this green line or it doesn't give you a 9 to the downside, which it probably will, the sequential will keep going, but that's when it cancels. On a daily scale, it's at double support plus sequential 13, but it's not a reversal candle. So I would be patient and I would wait and see what happens tomorrow. But this is not looking good. If tomorrow is a down day that closes below the moving average and below the setup trend line, then I would be anticipating lower prices, at least down to 76, if not lower. So this thing has gone down 50%, almost 40%, and I just don't see anything slowing it down. It's very possible that it reverses tomorrow, but if it doesn't, then it has a lot more outside, a lot more downside, for example. Would I take a shot at a long trade here tomorrow? Only if I saw strength. If I saw a strong stock market opening week and I saw strength in this asset, would I consider buying here? But guess where my stop loss would be? My stop loss would be just below Friday's low. And if tomorrow is a lower low, that would be bad. Like, I don't want to see a lower low. I want the stock to open flat, open where it closed on Friday, and start to rise. And then I can buy into this thing at like $84, and I can set my stop loss at $82.50. So that if I'm wrong, I know very quickly. But if it goes up, it can go up to the moving average. But I am conscious that we could go down into a 9. Okay. All right, next question. Can you talk about price action in relation to... Oh, I thought I did this already. Let me read this. Price action in relation to past halvings. We covered that already. Good. I have one last question. What degree of automation, in your view, makes sense for traders, particularly those who use sequential? Just a general question. I'm fascinated in this area, combining human and machine intelligence. Well, you have to come up with a rule set for sequential in your trading. Like, the sequential doesn't come with an inherent rule set. There's 1,000 different ways to trade sequential. You have to, come up with a rule set that is programmable. Then you have to find the right programmer to program it if you are not able to do it yourself. I have an idea of my rule set, but I would need to sit down with a programmer and code it and then back test it and check it and test it and test it and test it. And I have no desire to do that at this point in time. Maybe I will in the future, maybe I won't. I don't like automation because I think automation gets you into trouble. You have to be constantly on top of it. If I want to be constantly on top of it, I might as well just actively trade it anyway. It's very difficult to design profitable trading algorithms that you don't have to adjust, every few months. And it becomes almost the same amount of work. It's probably easier, it's probably better, but you also have to trust your developer. I don't have a developer that I trust like that, so I don't think I would let anyone code it. I have to learn coding myself. I'm not a good enough coder. So that's my view on it. There's nothing wrong with it. I just never done it. Okay. Okay, next. I don't really have an answer to this. Maybe if we had more time. What are your 1 to 2 things you wish TradingView could do that you can't do or it doesn't? I'm pretty happy with TradingView. Kind of does everything I need it to do. Maybe connect to my broker, which it doesn't for some reason, my trading broker. But that's, yeah, I don't really have a problem with TradingView at all. Kind of has everything I need. Maybe a better coding language, not invent your own Pine language, but like use like Python or something to do stuff. That would have been nice. Like everyone knows Python pretty much. That's pretty much it. More historical data, but I know it's expensive. That's about it. Yeah, I don't want to spend too much time on this question. We're already over our time. Okay, let me see if there are other questions. Someone asked about climate change. I don't know if I'll get into it. Let me see if there are. I have a few more very, very quickly. Going back to interest rates, what leads to negative interest rates? Basically, slow economic growth and slow inflation. Like it's the government wants you to spend money instead of hoarding money. That's what leads to negative interest rates. Free market leads to negative interest rates, right? Like if people don't want to, if people are willing to put money in a bank and not get paid for it, they will. So the rise in interest rate happens when you try to convince people to do it. Just think about it in your own personal way, right? Like if your cousin wants to borrow money from you, how much interest would you charge him? If you really don't want to lend him the money and you think it's risky, you're going to charge him a large percentage. If your cousin has amazing ideas, you're going to lend it to him very, very cheaply, right? Same thing. When you have to convince someone to borrow from you, you're going to charge them a lot. If that made sense. All right. Let's look at another stock. Let me see here. So it bounced off of earnings to the upside. It might have finally bottomed. It's been going down for quite a while. It's the daily chart. Topped at $120 and went to $50. That's a big enough pullback. If this company is fundamentally sound and it's not vaporware and it has clients and it has profits, this could potentially start going back up. We can look at the weekly chart, and it was a big bounce, and it happened on a 9. Beautiful. It happened on a double 9. And look at the top. The last top happened 1 candle off the top, which is unfortunate, and a beautiful 9 right at the top. So this is an asset that really likes to follow sequential. It really does. And definitely a buying opportunity right here on this 9 early in the week. The week went great. And I mean, I still have my reservations, but if this stock can go above this moving average on a weekly scale and make its way to like 59.30, and on a daily scale, that would be like here. I think it's got room. I think it certainly has room up to 66. So yeah, Not the most perfect trade, but if I had to put my money in the stock, it would definitely be on a long trade than a short trade. And you're about to get the bullish crossover. Ideally, I'd want to pull back into the crossover and buy off the crossover, closing the gap. Like, I'd want to buy this thing at like $54, fall into the cross, and then bounce up. But you may not get that. It may run away with it. I want to see this count reset. I want to see this go to a red one, and then a green one, and then a green two above a green one in the $54 vicinity. All right, let's look at, let's quickly follow back up with the Australian real estate. Yeah, see, I don't have it. I don't have it. I can't. If I can't pull up the chart, guys, I mean, that ticker doesn't give me anything, so I can't help you. AXRE is, I don't think either of these are Australian real estate, so I don't know what the hell that is. And oh, it's AXRE, yes, AXRE. And that's F, so I don't have it. If I don't have it, I can't look at it. All right, and I have one last question. I'm new to TA and sequential. Could you review some TA techniques that may determine a suitable price to add back into one's total stash? Well, at the moment, it's not really helpful, right? I mean, I talk about this in daily videos. There's really not much insight I can give you. At the moment, I mean, I ideally want to use the weekly chart to, ideally I want to use the weekly chart to enter long-term trades. And the weekly chart has told me to be in cash for the last 6 weeks, 7 weeks, God knows how long, right? And when that changes, you'll hear me say it on a video. This could happen at a new yearly high. This could happen after a big pullback. Like, nobody knows. I don't know either. So that's pretty much it. There's really no other insight. All of that you can get for free from my YouTube channel. I mean, that's the kind of things I talk about all the time. All right. All right. No, thank you for watching. All right, guys. I'm not going to get to the climate change question, but here's the question. Views on climate change and the possible coming ice age. I think an upcoming ice age is a lot more likely than the melting of the oceans. I think global warming is bullshit. And I would be more concerned about an upcoming ice age. I mean, this is why they don't call it global warming anymore. It's why they call it climate change, because they realize calling it global warming is stupid and bullshit. And I do believe that an ice age is a lot more likely than us dying from heat. It's just a bigger concern. Getting an ice age is a much bigger concern. And yeah, that's pretty much it. I don't believe that humans have the capability of causing long-term climate change. I think humans are very bad in their cause of pollution. Yeah, I got to put together. I was going to do a crypto scam with Tyler Jenks on climate change. Unfortunately, he passed away. I'll try to pull some resources together. But just Google the polar bear population. You'll see it's exploding. Google independent research on how much ice there is on the planet. You'll see it's rising. Like there's lots of metrics that are showing you that the planet is actually cooling, and it's very scary. Like, it's very scary because a lot more people die of cold every year than they are of heat. Let's put it that way. Way more dangerous for the planet to be cooling. So just keep that in mind. We cause a lot of pollutions. I mean, we can burn down the entire rainforest in
down in Brazil, and that would be very, very bad. Is that going to permanently change the planet? Probably not. It'll, kill a lot of species. It'll restructure the food chain, but the planet will go on. And if all the humans disappeared, the planet will correct itself. So humans cause pollution, and it's bad, and it kills people. And but the change in temperature is due to the sun, is due to factors outside of our control. And if you put a lot of CO2 in the air, you're just gonna make bigger forests and create bigger trees. If you put more oxygen in the air, that's even more dangerous. That means it's harder to put out fires. Fires create more CO2. A volcano blows up. Like, if another big volcano blows, I mean, nothing humans have done with CO2 or any other gases even compares. Like, if another Mount St. Helens or another one in Iceland, like one of those volcanoes, in a day, it puts more crap in the air than humans did in 20 years. Like, all right, guys, I'm gonna leave it here. Stop the screen share. Still recording. I'm gonna wave goodbye to you guys. Didn't get a chance to let people speak. I mean, I could turn on your mics if you want to say something real quick. I am gonna cut the recording, and I'm gonna stop the recording now. And then if you guys want to say something, I'll turn on speaking privileges.